I hand over the mic to you, sir. May I have Mr. Sudipto to please join us on the dais?
Very good afternoon, ladies and gentlemen. Indeed, a great pleasure again to be with you. First, let me continue with the earlier session, two important points. First, our ESG value of this session lies in finishing in time so that we do not cut into your lunchtime and make you starve. That's our first ESG value. And the another is a note of caution and warning to all of you. While Kaushalji and Ms. Namrata Narayan said that AI, and everybody said AI doesn't threaten our job, I have slightly a different view. AI does threaten our job, particularly the old generation chartered accountants. If they do not change, they do not adapt to, and they do not unlearn what they know, unlearn what they need to know, and how to exercise judgment. Unless they do that, they would be out of business, out of place. So that's a note of caution to all of you. The auditing that I read as a chartered accountant is no more relevant today. The accounting standards that I read as a student is no more relevant today. And therefore, unless we adapt and change ourselves, we would be irrelevant and out of place in the market. So that's very important. The second thing is that this session is on non-financial reporting and disclosure. I have already shared my thought in my inaugural address, and I would not take any much time and give time to the other distinguished speakers. As a chairman, I always carry the privilege that when I do not know, I can remain silent. When I know, then I can always intervene to show that I know. So with that, I will first hand it over to Ms. Sarika Gosain. I know she is very expert and she can talk hours and days together. But in the interest of the time, and as I said, our ESG value lies in finishing in time. And therefore, may I request all the participants to be as crisp as possible. Over to you, Sarika ji.
I have 10 minutes, okay, fine. Good afternoon, everyone. My name is Sarika Gosai, and some of you or most of you might have seen me talking about accounting standards, auditing standards, sometimes on Companies Act, being a chartered accountant and a company secretary, because that has always been my first baby. But for past 2 years, I have ventured into the ESG practice, and therefore my second baby has born. And being a new baby, it's taking a lot of due care and nourishing, etc. So I have been talking on ESG, etc. for quite some time now. Last time and last year we had spoken about BRSR. So BRSR has an extended arm, which is a report card now, which is an ESG, and we would be talking today about ESG rating, since it is the future for most of the listed clients and other clients going forward, and will be one of the main substratum for the business continuity of certain companies. So let's get started. Let me know if my screen is visible. Yes, it is. So first of all, we would like to understand a bit as an introduction, then ESG as a new credibility tool, as I just mentioned, then ESG rating, what is the need for that framework. Then we'll understand about few SEBI regulations around ESG rating for listed clients, and then we will understand what is the importance of ESG rating in a quick manner. Then we will understand the components of ESG rating, what exactly we should look at, and last but not the least, how we will look and link the BRSR core, which is a new requirement, with the ESG rating. So first of all, as an introduction, we know what is ESG. ESG is a triple bottom approach, and the reporting of ESG in all these three domains is the ESG reporting, or the sustainability reporting, so to say. We have multiple frameworks across the globe, including India, to report sustainability in these three parameters. But in India, it has been recently introduced as BRSR, that is applicable for top 1000 listed clients. Last year was the voluntary year, and the current year which is going on is the mandatory year. I have been doing 7 listed clients in terms of the BRSR compliance. We are hand-holding them for the BRSR reporting and the ESG roadmap. Last year, 150 plus companies had reported on voluntary basis, and therefore we are leveraging on those reporting. It's a dynamic reporting, and you will see, and I'm sure my peer colleague Deepa would highlight some of the aspects of BRSR reporting. It's a dynamic reporting. It is changing and will keep on changing, accommodating the requirements as we go along. It is based on 9 principles of NGRBCs. Once we will talk about BRSR, we'll understand what are NGRBCs, which are clubbed in the ESG framework. And we would be seeing that the BRSR would be the starting point for the listed clients and other clients as the ESG rating. You might be wondering why I'm speaking from this side, not from the podium, because of my height constraint. I recently broke my leg, so therefore I came back to my height again. So that's my original height, and if I speak from there, you won't be able to see me from there. So coming back to my topic, ESG rating, it's a new credibility tool. Why it is so? Because people are taking initiatives around ESG, they are preparing reports, but what's the outcome? It's like we are just studying and not giving the examination. So ESG rating will be sort of a new reporting card for the companies to demonstrate their reliability, their credibility to stakeholders at large. There are multiple ESG ratings in India and across the globe. India, it's at the nascent stage. There are a very few rating agencies, what you can see on the screen. But internationally, there are a lot. Why there is a need for ESG framework? Because currently there are a lot of ambiguity around the ESG products. What are these? There is a lack of transparency and the reliability and inconsistency amongst the ESG rating tools and the outcomes thereof. Therefore, the people are confused which rating agencies to go for. The market so far is unregulated. Therefore, there was a strong need to have the ESG rating framework in India at least. And as I just mentioned, there are a very few rating providers, and therefore there was a need to harmonize the entire system. With that concept, if you could see, in last year, SEBI had issued a concept paper on ESG rating. Later in the year 2023 in February, they revised that concept paper and brought 3 concepts: ESG rating, ESG investing and value chain partners. Then they issued a consultation paper again on ESG rating providers to strengthen the requirements further. On 14 June 2023, SEBI LODR got amended to incorporate the BRSR requirement and the BRSR core requirement. And then recently, credit rating agency amendment rules have been issued to incorporate the entire guidelines around the ESG rating. And then very recently on 12 July, couple of developments happened incorporating the BRSR core, revising the BRSR format and including the ESG rating regulations. So this is a welcome move for Indian companies, because we are now gearing up with the government and we are also gearing up to meet the requirement of our global peers. Now coming to the SEBI regulation, as I just mentioned with respect to the ESG providers, my request is just to bring your energies back, because that's a very important topic and that's the future for companies. Currently this requirement of BRSR and sustainability reporting seems to be applicable only for top 1000 listed companies, but this requirement will extend to other listed companies and eventually to other companies which are unlisted as well. So it is the right time for us to invest, and more specifically for chartered accountants and company secretaries and professionals like us, because we are well equipped with the research thing and we can guide our clients because we know them very well, we know their financial data. So going forward, we'll see the integrated reporting where we will see the clubbing of the financial numbers as well as the non-financial number which relates to ESG. As ma'am just mentioned that we are not far from the situation when we will see the integration of both these two numbers. So if we look at the SEBI regulation, because of the BRSR came into picture, that gave us a thought of ESG rating. Therefore, the concept paper, as I just mentioned, last year the concept paper was issued, which is recently amended, And if you could see the last 3 bullets, very, very important, and we'll be sharing this slide deck with you as well. With the introduction of that concept paper, and SEBI is trying to embed all these requirements into the SEBI regulations as well. 3 new concepts have been born. One is the BRSR core, which I am sure Deepa would be talking about in detail. So this BRSR core would be the key highlights or very important aspects of the BRSR reporting what we have been doing. This will become the starting point for the ESG rating for the companies going forward. And as an additional ESG rating product, BRSR core is recommended to be used as the substratum, meaning thereby the rating agencies would use the BRSR core as a product to rate the company on those parameters. That's a very important and welcome steps from SEBI. So how this SEBI framework and the rating agencies thing would come into picture? There are a lot of rating agencies, as I just shown on the previous slides, one of them. So every rating agencies have their own methodology. So SEBI has said that whoever wants to rate the listed clients or their listed securities have to impanel them with the SEBI, just like we have a data bank for the independent directors. So that database would be used by the listed clients to select a rating providers, and out of those they can choose and get themselves rated with the same methodology. So there will be different types of rating providers, there will be application procedures, they have to maintain the transparency and they have to ensure the conflict of interest is not there. They have to follow the code of conduct. So these are some of the parameters what have been laid by SEBI for the rating providers, so that the consistency across the rating procedures can be brought into picture, and we can rely on the rating which has been provided by the SEBI accredited rating providers. They have to have the policy and the rating monitoring process in place. They will also review the rating which are given once for all on a periodic basis. There have to be some mechanisms to disclose the reporting mechanism also. Additionally, there are some regulatory requirements which they have to follow. Now, what is the importance of ESG rating? Can anybody tell me quickly, just 30 seconds. What is the importance of ESG rating for the listed clients or other stakeholders? Will you have the reliability in place? Will you have more credibility on those companies who are getting? You will have a comparability tools between and amongst the companies, which company should we go for as an investment or otherwise. So quickly, technically, what are the importances? Those will be bound by regulatory compliances, so we will have more reliability. The companies will have more, risk awareness, and they will be used as a tool. Then there will be a reputation, and there will be something which they can demonstrate to the public at large. And then the data what they are using will be widely available for the stakeholders usage. And last on the screen would be, there will be increased and improved relationship, better relationship with all kind of stakeholders through this rating agency rating what they get. If we look at what components really, I know I'm just going a little faster, but that's the mandate from here. So if we look at what are the components what are to be looked at while we are going for ESG rating. Environmental factor, because as I mentioned, ESG rating is solely based on the 3 parameters ESG. So all the parameters which are covered in the buckets of ESG will be looked at by the rating providers to see whether the company is fit for the rating. And then the risk assessment will also be done by the rating providers to give them the appropriate rating. The other parameters which you can see, there will be some scoring methodology which will be used as a common platform by the rating providers. Then there will be certain disclosure requirements to maintain the parity across the sectors, across the companies. Then there will be some investor focused areas which will be embedded in the rating parameters. And last on the screen will be, as I mentioned, all the listed clients now onwards who want to get the ESG rating done have to use the SEBI impaneled rating providers. They cannot go beyond that. They have to use them, and that will add value to their rating. This is the last slide of my session, and very important one. So as I just mentioned that recently the BRSR core concept has been issued. So apart from the BRSR format, sorry, there are some key items which are called as BRSR core. So BRSR core, as I mentioned, will be the starting point for the companies to get the audit for and to be used as the ESG rating parameters. So how I can link my BRSR core with ESG rating? It's very important. Since BRSR core would be starting point, as I just mentioned, they will be used by the rating providers as an additional product. So they can say we have rated the company on BRSR core. The BRSR data what the company has given, that is based on the ESG parameter, will be used for the ESG rating providers. It will be easy to gather the data from one place, from one report. Since it is coming from SEBI, it will give them a reliable data. Therefore, the credibility and the usability of that data will be more for the ESG rating. The materiality what we are using for the BRSR will be used for the BRSR core as well and for other frameworks as well. So you might have seen certain companies, and you might have seen Reliance, they are using 6 frameworks to report their sustainability. So materiality differs from one report to other, but with the introduction of BRSR core, the materiality can be harmonized and therefore can be used for the ESG rating as well. And last but not the least, it will increase the reporting and transparency because it is coming from the regulator. That's it from my side. I'm happy to address, if sir allows, to address any query. Yes, sir. Sir, let me ask him first.
Maybe we can have the questions later.
Later, sure.
Yeah. You know, the time limitation at times helps us most,
I was within time, sir.
because the limitation of times has helped you in giving a comprehensive presentation in a highly qualitative manner. So thank you very much. And we have a pleasure of having Sudipto here. Great pleasure to have you. I thought that we should have a third's eye view on what the law is required and what the profession is doing. And Sudipto is writing for the ET, and we often see and regularly see its writes up on the ESG and the climate change and related issues. Highly well informed. He writes less but tells more. And I am of a considered view, and that's why we have given significance to ESG in this seminar, that the ESG reporting or sustainability reporting would be as important as financial reporting, if not less, in these times to come. So we need to be careful as a profession. Others may enter and may threaten the existence or the relevance of those who are concerned with the financial auditing alone. There are requirements in the standards to look into the climate or ESG or sustainability reporting, but they are very diffused, not focused. And they even require that if there are risks, if you have non-financial information that relates to your financial statements, the auditor has a responsibility to go into and report. How many of the auditors know about that? And how many auditors would relate those the statements in the non-financial reporting to the financial statements? How many of the auditors would really interact with the top management? Leave alone top management, even the CFO regularly, to understand the business perspective. How many of the auditors would know the industry, the macro issues, the micro issues, the global issues, and so on and so forth, and technology issues? So the auditing is far more. And if we make the auditing that enlarged and extended, I'm sure the auditor, the audit profession would attract most talent, which is deserting now. I will not take much time, and I will request Mr. Sudipto to give his third eye view about the ESG.
Thank you, SHM, and thank you, Dr. Haldia, for those kind words. Thank you, SHM, for this inviting us to this panel. And you must be wondering, that what is a journalist doing here? We should be out there reporting. Yeah, we do reporting, but of course, that reporting is much less complex than what you guys are doing in terms of ESG or even regulating of ESG is definitely way ahead of what we are doing. I just wanted to sort of, give you a context. I don't have a presentation here. Just to give you take you a bit back and give you a context from where we are coming from in terms of ESG. You see, ESG, if you see, started somewhere in 2004. Now, as you all know, E, S, and G. Now, the term ESG officially came into the picture around 2004 in a United Nations backed report called Who Cares Wins. I would urge all of you to have a look. It's available you can do a Google search and get the report out there. That's the United Nations report, Who Cares Wins. The report is essentially a bunch of recommendations by the financial industry players to better integrate ESG issues in financial analysis, asset management, and securities brokerage. So that was the original idea, and that's how ESG came in. Now, the person and his team who are credited with this term ESG is Paul Clements Hunt. He and his team, they were part of the same report, who prepared the report. They first coined the term ESG. Interestingly, Paul also happens to be a former journalist. So there's an interesting sort of a backstory which one of my colleagues came across while researching on the subject, is that when Paul and his team were discussing about how to put across ESG, they thought of calling the term GAC or GES. The thought process was that governance is the most important aspect of the three, and if you have the right approach to governance, you will get E and S right. So, but after some deliberations, they realized that ESG is more easy on the tongue. So, okay, we'll go with ESG. My takeaway from this narrative was that somehow the governance part, which is most important, comes at the last, and which is a reflection of the whole, I would say, the journey of ESG over the last 20 odd years. Also, interestingly, the same report, Who Cares Wins, in a way introduced ESG to the world, left a lot of questions about developing the ESG framework, open-ended, and herein lies a lot of the seed of all the regulatory challenges we have seen over the last 20 odd years faced over regulating ESG. Now, the report, and I quote from the report says the regulatory framework should require a minimum degree of disclosures and accountability on environment, social, and governance issues from companies, as this will support financial analysis. And the formulation of specific standards should be, on the other hand, rely on market-driven voluntary initiatives. If we look at this sort of open-ended and framework, what it has done is that over the last 20 odd years, we have seen several frameworks and standards coming up, each of them looking at different aspects. The reporting frameworks, as you know, provide guiding principles, while the standards give specific technical requirements for reporting. And both are used in tandem while we are applying them. Now, interestingly, some of the popular ESG reporting frameworks are Dr. Haldar was in the morning, GRI, Global Reporting Initiative Framework, the Task Force on Climate-Related Financial Disclosure, TCFD framework. Then we have the International Integrated Reporting Council framework. There's a Climate Disclosure Standard Boards framework. Also, we have some common ESG reporting standard setters. One is the ISSB, which is the International Sustainability Standards Board. We also have the Sustainability Standards Accounting Standards Board, then the European Financial Reporting Advisory Group Standards. Now, that's just to name a few. Now, there are quite a few more, and India, interestingly, has come out with its own sustainability reporting standards. The ICA has done that recently, and we're increasingly going to see more use of that. Now, what it has done is that, with so many standards and frameworks in place, there's a sort of a alphabet soup of disclosures. and performance parameters that as auditors, as issuers, you have to go through. And interestingly, there was one EY global survey which found that the provisions under the multiple standards have grown has grown from 400 to 600 between 2016 and 2020. And if you go back to corporate India's twist with ESG began with the National Voluntary Guidelines by the Ministry of Corporate Affairs. This was in 2009. The latest of that, of course, is BRSR framework, which was referred to, and of course, which will be discussed further. Now, as we know that BRSR framework, all the ESG parameters are captured and reported, disclosed for the top 1,000 listed companies through the BRSR framework. Now, if you go to the regulatory aspect of ESG in India specifically, there are three sort of, I would say, bodies here. One is Ministry of Corporate Affairs through the Companies Act 2013. There are provisions in that which sort of have an influence on ESG. There are two financial regulator sectors, which is the Reserve Bank of India and the SEBI. These are the other two regulators of ESG. Now, if you look at it, the BRSR framework, of course, was conceptualized by SEBI and lays out the disclosure requirements for business for assessing the ESG performance. Now, we come to RBI. Now, RBI, through the Sustainable Finance Group, SFG as they call it, has been monitoring the climate risk exposure of financial entities. It has been undertaking stress tests to assess the impact of climate risk for macro financial stability. And we are going to see much more activity from RBI now. They came out with a study recently about a couple of months back, looking at the green economy, how the green economy is going to look like. And I think I will urge all of you to go through it, because it will give you a lot of deep insights into how the regulator is thinking about the green economy. And going forward, all of us will be engaging with that. Other part is that, in this whole regulatory flux, what has happened is both policymakers and businesses feel that the need for integrating the financial and the non-financial reporting standards. And that's where we are moving now. So ISSB has recently come out with a baseline standard framework for sustainability, which is a voluntary standard guideline global. And each jurisdiction has to take a call whether they want to go with it or not. India hasn't taken a call, but India was part of the discussions. So we're going to see much more of that, and I believe the ICAI is now thinking of working with ISSB on that front. So we are going to see much more evolving standards coming up from there. Now the dilemma what corporates face, or the corporate India face, is that they all want to look good on ESG, but they don't know how. And I'm pretty sure as auditors, as people of influence who are interacting with your management, you realize that the question would be that, okay, how are we on the top of the, how do we look good? How are we on the top? But the problem here is that, the fundamental issue here is that, the lack of definition and uniform standards. And this is something which is going to evolve over the hopefully over the next couple of years. But you still have to stay with it. We have to sort of, we'll have to deal with the sort of the multiple standards and the formats. And I believe in the next 2-3 years, we're going to see a sort of a common standard evolving globally on sustainability and ESG. Now, another question that we commonly face, like being a business journalist, we talk to corporates, and a lot of the times the CXOs and the business owners, they ask us sort of, when we talk about ESG, they ask us, can you give us a business case for ESG? Now, my problem with that question is, if you're looking for a business case for ESG, to invest in ESG, that there's a fundamental problem in your thinking, I would say. Because if you look at the, the way, if you just look at how corporate India has evolved over the last, say, 50, 60 years, 70 years, at the time of independence, there were a lot of big business houses, which sort of, those names, some of them are still around. And if you see, a lot of them had a deep connect to the society in terms of, say, they were setting up charitable organizations, hospitals, they were setting up educational institutions, they were placing up places of worship. There was a connect with the community. And of course, over the years, there has been an evolvement of that. Now, of course, CSR has come in. There's a 2013 Act, the CSR has come in. A lot of questions we get we are asked often is, the overlap between CSR and ESG. And this is something I think a lot of people are grappling with, what is the correlation between ESR and CSG? If you look at it broadly speaking, CSR, as we all know, is part of Companies Act and 2013 Companies Act, and it is followed from there. But CSR, as you go by the law, is essentially a subset of ESG. So ESG is much broad, much more wide than CSR. And some part of your CSR activity will get captured in your ESG reports. So it's important to carry on with your CSR activities, and also the ESG is much more wide and broad. So I think there's a confusion somewhere, and we get asked often by many people that, I'm already spending 2% on CSR, why do I need to invest on ESG? CSR is something that it's a philanthropic, it's charity, you're giving out. You're supposed to give out 2% of your net profit over average net profit over a period of 3 financial years. Now, ESG is about your own business. How sustainable is your business? And what the ESG parameters, performance parameters which are captured by the BRSR reports, essentially they are signals of how sustainable is your business. Now there's a confusion that again we come across here, and this is something which I like to highlight, and maybe the message has to go across to the the boards and the corporate boards here. Please don't confuse ESG scores with sustainability, because the ESG scores are just reflection of your ongoing sustainability journey, and that a business is on. They don't define sustainability. Also, if you want to understand ESG better, you have to unbundle the E, S and G to understand them better. So it's not a ratio which will sort of, okay, I have got a high ESG score, so I'm good to go. So you have to unbundle E, S and G, and then only you will understand them better, work on them better. And finally, sustainability journey is a long one. It's a sustainability journey which is an ongoing journey, which the journey itself is a destination. Once we try and understand that, I think it's better for us to sort of, appreciate all the regulations and the laws which are coming in from the ESG format. Lastly, I think also, the amount of, say, the treatment we give to our financial controls, the same treatment we need to give to our sustainability controls, which is not easy. We are there's a lot of subjective factors to it. But going forward, financial and non-financial reporting are going to merge, and we have to give the same control importance to our sustainability controls also, which is a message I would like to sort of leave with you all. Thank you.
Thank you, Sudipta. You said that you are a journalist, but possibly you know most of better than what we know on the subject. And very important point that you highlighted was that the governance comes at the last. And you rightly said, if the governance is set right, E and S would follow automatically. So very important message that you gave. Now over to you, Deepaji, on BRSR. And we look forward as to how to comply it and how to resolve the conflict between sustainability and BRSR.
Good afternoon, everyone, and thank you very much for calling me again and giving me this opportunity, especially Dr. Haldia, Santoshi, and the entire SHM team. A brief intro, my name is Deepa Agarwal. I'm a chartered accountant and in the profession for the past 22 years. Happy to see some of the familiar faces, including my earlier colleagues, so just wanted to acknowledge that. A very important topic, and my predecessor my colleagues have already made my, the presentation very simpler, because now you know what is ESG, what is BRSR, and what are some of the key important points which you need to keep in mind when you prepare for the BRSR disclosures, and why we are talking about the climate change. And I think I also took notes when the earlier session was going on. So while I'm constrained about the time, but I will, kind of want to stay focused on the BRSR core and what should we actually be doing for making sure that we are prepared in whichever role we are there, whether we are there as management, preparers of the financial statement, whether we are the auditors, whether we are the assurance providers. So I think sustainable development goals everyone knows, so I'm going to just skip this and come straight away to the BRSR regulations. So India took the lead, and if you remember, May 2021 was the first year when SEBI issued this circular and making it voluntary for the BRSR reporting for the companies. So mind it, there are two things. One is the reporting by the companies, and second is reporting by the assurance provider, which will happen from the next year, though currently it's voluntary in nature, and many of the assurance providers are providing this voluntary reporting. There are IFEX surveys which are available in the public domain, wherein you can look at the mapping of the assurance providers. Who are those assurance providers? What is the level of assurance, whether it's limited or reasonable? So I think those surveys, research and publication will be really helpful when we gear up for the reasonable assurance in the coming year. So coming back to the BRSR reporting for the companies, now effective from this year, which has already been going through on 22-23, it is mandatory for the top 1,000 listed entities. And you will see once the annual report is out for this year, you will see every company covered within the top 1,000 based on market capitalization will carry the BRSR reporting. The SEBI issued us a consultation paper referred by Sarika also in Feb 2023, and later on they issued a board minutes on 29th March wherein they made it mandatory. So thereby only the messaging was very clear, okay, India is the first one going on for the reasonable assurance. So while Sudipto covered the international regulation, the frame, I'm not going to repeat it, but I can just say that India is going to be the first one to talk about the reasonable assurance straight away. Not talking about the limited assurance, whereas if you look at the EU regulations, or if you talk about the other countries, they are taking probably a slighter way. You know, they are talking about limited assurance to begin with and gradually moving to the reasonable assurance. I think many of us might be the auditors sitting here or might be interacting with the auditors in our role. I think you will realize that reasonable assurance is a much higher level of assurance. And when we are talking about the non-financial reporting, SEBI also talked about value chain. I think value chain is very, very important. So I remember Namrata mentioned about the carbon emission, and you know, those will be given preference who have the low carbon emission. So value chain, I think SEBI has made it mandatory for the top 250 listed entities from FY 24-25 that there will be a requirement for a disclosure and assurance in a gradual manner. So value chain they have defined that will be covered, and they will have to obtain the disclosures from the suppliers and basis of purchase and sales. So disclosure has to be made as part of the listed entities annual report. So think about a situation when the company's annual report will carry the BRSR for itself as well as for its value chain entities. And if you remember, if anyone has seen the BRSR format, it is very much available. You can just do a Google. You can even see the BRSR report currently being voluntarily published by the companies. It has a very detailed disclosures, and it captures the 9 principles basis which the disclosures are given. Some of the companies are also giving it on a voluntary basis on a consolidated basis. So everyone is familiar about the consolidated financial statement. And now when we are talking about the non-financial reporting, we have to think about a situation where there is a company which have multiple subsidiaries presence across the globe, how that is going to happen. So currently it's not mandatory. The BRSR guidance which you see, which is there in the BRSR format, they say that the company may choose to do it on a standalone basis or on a console basis. So reasonable assurance, so SEBI issued BRSR and then made some changes in the recent circular which was issued in July, and they made some of the amendments to the BRSR format because they want to issue this BRSR core. So BRSR core is nothing but a subset of BRSR. They carved out some of the KPIs and they said now going forward with from the year next year 23-24, the assurance provider will have to provide a reasonable assurance on those select KPIs. So they have issued the format of BRSR core, which has even the methodology, a very brief methodology in terms of how to measure and what kind of computations have to be made. SEBI on assurance provider. So if you look at the circular, they talk about that the assurance provider, the board has to decide that the assurance provider should have the necessary expertise. They haven't referred to any of the assurance framework standard. They haven't specified what are going to be the minimum qualification of that assurance provider. And if you look at the international position, as I mentioned about the IFEX survey, there is a slide on that also, but I'm going to cover here only that, approximately there's a mix, 63% of the assurance is provided by the audit firms and the remaining are provided by the other assurance providers. So other assurance provider can be the subject matter expert, and as it involves a lot of science as well, so definitely the subject matter expertise is very important. No assurance standard is specified, but we have the global standard ISA 3000. Largely ISA 3000 is currently being followed. If you look at the voluntary report and the assurance report, you will see most of the people are using ISA 3000. I was part of the formulation of the standard of Indian standard SA 3000 and SA 3410, which is on greenhouse gas emission. SA 3000 is very much aligned to ISA 3000. And if anyone wants to apply that standard, I want to just make one statement. The definition is very clear, the applicability is very clear. For any sustainability report being issued under that standard, that has to be issued by the member of the firm who is registered with the ICAI. So that's a very important point. I just want to highlight it. If anyone is going to follow that standard, only a chartered accountant can provide that assurance. However, SEBI has not referred to the standard or to the framework or to the assurance provider. So on the right-hand side, you can see the standard on the ICAI. The applicability date of the standard is that it is mandatory from current year, but because there is no reference, then there is one cannot say that this is the only standard which can be applied. On the BRSR format, I think I will not cover much in detail, but the formats are there, and you can see these are divided into 3 sections: general disclosure, management and process disclosure, and the principal-wise performance disclosure. BRSR core is a subset of BRSR, and it is based of 9 attributes, and I have a slide to show you. Yeah, these are the 9 attributes. So if you see, they have just carved out from the entire BRSR report these 9 attributes on which the regulator is looking for the company to get a reasonable assurance. And why reasonable assurance? Sarika covered in much detail. To increase credibility, to enhance reliability. The way she explained about the rating, I will say the assurance is something which is being looked by the regulator. So change in GHG footprint, scope 1 and scope 2 emission. So when I started, working on this subject 3 years back, in fact, I was also struggling to understand what is a scope 1 emission, 2 emission, and scope 3 emission. So there is a scope 3 emission also, which is not there in this framework. Why? Because that is very difficult to calculate and measure, because that is something, the emissions which are being generated indirectly, probably by your value chain entities. So this is just for your eyes that these are the 9 attributes on which the core assurance will be required from the next year. This is just a survey. Again, there's a publication, wherein the survey was done on the top 20 listed companies listed on the National Stock Exchange based on market capitalization. Out of these 70%, out of these 20 companies, 11 companies have presented BRSR disclosure at standalone entity level. And there were 2 companies which have presented some information for the group other affiliates also. As regard disclosure pertaining to 9 principle in section C, wherein companies mandatorily provide information for essential indicators and voluntary for leadership indicators, 12 companies have disclosed information for all the essential indicators, and 6 companies have disclosed information for all the leadership indicators. So this is just to show that currently also it's a voluntary requirement, then also companies are giving, because the information is very relevant. Stakeholders are looking for the information. And I think Sudipta mentioned about the one important point is there is lack of uniformity of the standard, and the standard which there is a need that there should be a standard which one should look at. So yes, we have the framework for the listed entities, but currently there is no prohibition that the international frameworks cannot be used. So I'm expecting or hoping that looking at some companies are using the GRI framework or the TCFD framework, they might continue to provide those disclosure. So I think there is a need for the global, the one of the framework which should be followed and understood by these stakeholders. This is a survey. I think I'll not go through it given the time constraint, but you can go through whenever you have a chance. You can look at this IFEX survey. They have performed an annual benchmarking study on global practices in sustainability disclosure and its assurance for 3 consecutive years. So they have given which companies have reported on ESG information, which standard has been used, and what level of assurance is being provided. Largely limited assurance is being provided. Some of the challenges I think which I just want to highlight, that if the companies will keep on giving this hybrid basis, some information on standalone or console as what we have observed, then probably it will not help the stakeholders. It is very important, as Sudipta mentioned, the establishment of control system and processes. So as financial statement, when we talk about financial reporting, we are very much familiar. Okay, we need to have the internal controlled ICFR reporting. Same goes for now for the non-financial reporting. If the assurance provider have to provide the reasonable assurance, they will ask for the control, they will ask for the control testing, they will perform the walkthroughs. So therefore, it is very important that the board should give attention, the audit committees or the management should give equal attention and focus to the non-financial reporting. Uniformity and disclosure. So some of the disclosure in the BRSR format may not be relevant for a particular sector. Though the guidance mentioned that you can state that it is not applicable. However, one of the challenge could be that in that may not be easily understood by the stakeholders. I think just some of the last messages in terms of the way forward, it is very important that the audit committees and the management give its adequate importance. Identify the key roles within the company when you talk about the various controls. There is a lot of data which is required. So I received recently a question, what kind of information should we provide in this particular column on the case on the disputed or on the, some of the cases filed by the stakeholders. So if you look at the information, even from the eyes of a CA or eyes of the other management paper, you will realize there is a plenty of information which is required from the past year, from the current, and for the current year. And when assurance has to be provided, one will ask for the evidence. So therefore, it is very, very important that the data coordination should be there between various departments by looking at the additional information. Developing SOPs and KPIs is something very important, and controls have already spoken. Independent assurance, so India is leading in terms of the reasonable assurance. And global developments, very briefly I'll cover 2 standards already been issued, not mandatory unless and until adopted by the the other countries. So CSRD I've already covered, and I've received a message that I have to complete. So thank you for all your time and for listening to me. This topic can be discussed for length and not just covered in 10 minutes, but I hope I'm able to give you some messages. Thank you.
Sorry, Deepaji, for curtailing your presentation, but I believe these are all learned participants, delegates. They need to be only thrown some light, and they are able to carry that forward. And I would suggest, Santoshji, if you can circulate all these presentations to all the participants for that. Now, with that, I request Mr. Rahul to come and present, and very important is the ECL provisioning. I thought the spirit of law, the spirit of RBI regulation, the spirit of accounting standard always required the auditors to look at the ECL. But normally what happened was that all of us went by the RBI norms, thumb rule of 2%, 3%, 5% provisioning. ECL, there are usual resistance, and they're bound to be. I'm sure Mr. Rahul would take us through as to what is the relevance and how the banks can overcome that.
Yeah. So thank you, Mr. Haldia, and thank you, SOCAM, for giving me this opportunity. As a brief introduction, my name is Rahul Agarwal, and I'm partner with MSK and Associates, working majorly with the assurance practice. And I have experience of around 20 years working with many companies in this area in the sector. So ECL is something which is not really a new concept, because it has been made applicable to many NBFC companies as part of India's implementation. In full form, it is called expected credit loss. But somehow it was not applicable to banks in India, and very recently RBI has come up with a discussion paper in January 2023 talking about the deliberations required for implementation of ECL in the banks. So if I take a step back and try to understand what banks have been doing so far, there are prudential norms which have been issued by the Reserve Bank of India, which are applicable to the scheduled commercial banks and other banks, which talks about how the provisioning needs to be made in case there is a default. So the underlying condition is that if there is a default and the customer is not making the payment and there is an overdue of 90 days, it becomes a substandard asset, and there are various thresholds which have been defined under the regulations for making the provisions. So all this is going to be changed in accordance with the ECL, because the concept itself talks about expected credit loss. And if I try to take an analogy here, that generally when a heart attack happens, I mean, the doctor actually gives stunt or some kind of medicine, so that's more like a default when it has already happened. But ECL talks about the scenario that when you have your parameters which are not in line with the standards, like for example, if the BP is going high, that's a time when you actually start to look into the health of your creditor, health of the customer, to basically understand whether the money is really going to come in or not. So, so that's what the discussion paper is generally talking about. So as I said, in January 23, the discussion paper came in where the RBI has invited the comments, and based upon the comment, the draft guidelines will be issued by the RBI. And the draft guidelines will also be shared with the public at large to get the comments before they issue the final guidelines. So what has changed? So as I said, that incurred loss basically stems from the default which has happened from the customer when the customer is not making the payment. Expected credit loss basically talks about a scenario where there are early warning signals that the money is not going to come from the customer. Like for example, if there is an overdue of 30 days, generally under the current regulations, the provisioning may not be so high. Whereas the ECL talks about that you have to make more scientific kind of assessment to understand whether the money is really going to come in from there or not, to make that assessment. What is the need of the expected credit loss approach? I mean, if the banks are not making the provision at the right point of time, there is a good possibility that the higher profits get distributed to the stakeholders through dividend payouts, and the capital adequacy may not be there. So that's the one risk which basically came out based upon the recent collapses which happened in corporate India, and that's a basic reason why ECL basically came into existence. If we compare with the global landscape, this has been already made applicable to companies at large, including banks. In India, the Ind AS implementation has been done in a selective way. For banks, it is under deliberation at this point of time, but for NBFCs, it has been largely covered. The guidelines also talks about the concept of capital shock, and that's a terminology which the guidelines have actually used, where the regulators has acknowledged that there may be significant impact on the transition date because of the higher provisioning requirements under ECL versus the incurred loss model. And that can be basically amortized over a period of 5 years, so that there is a limited impact on the capital adequacy. In terms of the applicability, it is currently made applicable to all scheduled commercial banks, not really applicable to rural regional banks and small cooperative banks. What is the definition of a small? That something is not covered under the guidelines, but that is subject to interpretation, and hopefully RBI will come up with the guidance into the draft guidelines on this. In terms of the scope, all loans and advances which are there into the balance sheet, that's obviously covered because that's the money which has been lent to the customer. In addition to the existing assets in the balance sheet, it also talks about the off-balance sheet line items, which includes irrevocable loan commitments. So think about a scenario that the bank has issued a sanction letter of, let's say, 1,000 crores, which is irrevocable. So there is a risk that if the money is actually lent to the customer, that can also go bad. So banks will be responsible to make assessment of that how much money can actually be bad, and make a provisioning for it. Okay, so under the current regulations, so there is a concept of a standard, substandard, and a doubtful assets, whereas ECL talks about stage 1, 2, and 3. Stage 2 is basically when there is a significant increase into the credit risk as compared to the initial assessment. So that's basically stage 2, where the provisioning needs to be higher as compared to what you make in stage 1. And stage 3 talks about a scenario where the money actually becomes doubtful, when there is actually an indicator that money is not going to come in. It's more like a loss event, or it's more like a doubtful kind of event. So that's more like a stage 3, where provisioning obviously has to be higher as compared to stage 2. Stage 2 talks about the concept of significant increase in credit risk. So let's say if you lend money today to the customer, there is an assessment about the credit risk, but the situation may change in future. The customer may not have the viability to make payment for the money. So even though default is not there, that's more like a significant increase into credit risk and may be categorized into stage 2, which means higher provisioning. There is a concept of valuation of collateral. The guideline says that, okay, when you figure out the prudential floor provisioning, the collateral needs to be valued based upon the distress valuation, and it has to be done every year. So it has to be done on annual basis. Whereas the current prudential norm says that, okay, you can get the valuation once in 3 years. So that's another change. Capital shock, I have spoken about that whatever incremental provisioning you have on day one, which is the day of transition, that can be amortized to P&L account over the period of 5 years. So there may not be one-time impact. Another important area is about the credit risk assessment currently under the guidelines, and as per Ind AS 109 as well, the assessment needs to be done at account level. So think about a scenario that there is a customer which has multiple business operations, cement operations, textile operations. So one of the business may not be doing well, and that's why there may be some probable default there. So instead of making an assessment at the instrument level, the guidelines say that assessment has to be done at the counterparty level. So if there is a probable default into one category of the instrument from the same customer, the entire customer has to be seen from the holistic perspective, try to understand that what is the risk underlying there and how much additional provisioning is needed. So this is one area where we see a big impact coming out of it, and this is also different from Ind AS 109 requirements, because there it talks about assessment to be done at account level, instrument level, not really at the counterparty level. Okay, so this is the categorization, how stage 1, 2 and 3, the provisioning has to be made. As I said that stage 2 and stage 3 has to be the higher provisioning. Stage 3 is more like a default kind of position where the default has already happened. You know that the money is not going to come in almost. Stage 2 is more like an early warning signal. I mean, think about a scenario that banks today report SMA 1 reporting, SMA 2 reporting, which talks about 30 days past overdue or 60 days past overdue. But there the provisioning is not really much in the today's guidelines. It just talks about 0.25% of total asset value in case of NBFC and 0.4% by the banks, right? Whereas under ECL approach, the provisioning may be higher based upon the assessment of the value of the collateral, what are the underlying risk, and what is the assessment done by the company and the banks. Another interesting thing is about the interest income. So in case the asset is lying into stage 3 where you know that default has already happened, their interest income, the guidelines say that it has to be recognized on receipt basis. So even there is a good possibility that money is going to come in, you are not going to recognize that on accrual basis. You have to wait for the customer to make that payment before interest is recognized. So that's another area where the guidelines are different from Ind AS 109 and also from the IFRS global standard. Okay, so significant increase in the credit risk, early warning signals, so that's more like a qualitative assessment, very, very different from the quantitative assessment which guidelines currently talk about. You have to get into the qualitative aspect to understand about the financial credibility of the customer, what are the change in the circumstances of the business environment of your customer, whether he's going to make the payment or not really wait for the default to be happening in future. So that's more like a qualitative assessment. And the guidelines also talks about some rebuttable presumption that if the money is not coming for 60 days past overdue at the counterparty level, so generally there is an assumption that it's more like a stage 2 asset. So that can be rebutted based upon the circumstances and the qualitative criteria. Default, I mean, that's almost consistent with the current guidelines. If it's an NPA, which is more like 90 days past overdue, that's more like a default kind of situation. Continuing default for 90 days. Restructured asset. So if the asset is restructured or securitized and it's under the monitoring period, so that's also considered to be a loss asset or a stage 3 asset. Instances which actually indicate that there is a failure to pay. So when you get to know that the customer is not going to make the payment, that's more like a stage 3 event, which is very different from the current scenario where you actually wait for the default to be happening. So even in this case, if the default has not happened, but you believe that it's going to happen, that more like become a stage 3 kind of event as well. Okay, so there are provisions talking about that an asset may be lying into stage 3, but the situation has now improved. So you need to classify that back to stage 2 or stage 1. So guidelines says that you can't just straight away transfer to stage 1 even though the situation has improved. You have to keep that asset under stage 2 for a minimum period of 6 months. So that's more like a cooling off period. So this may also create some sort of irony where you believe that the customer financial position has improved, but the asset is lying into stage 2, which means higher provisioning requirements and more impact on the profitability. CET1 and Tier 2 capital, I mean, the guidelines talks about the formula to calculate it, and under the standards, current standards, it talks about general provisions and the specific provisions. The question arises that how do you categorize ECL provisioning into general and specific, which is quite relevant for the purpose of calculating Tier 2 capital, which is more like a determinant to find out the capital adequacy in the bank. So there is a guidance available under the standards. As I said, there is a cooling off period concept of 6 months. If you transfer from stage 3 to stage 1, you have to wait for minimum period of 6 months under stage 2, which may mean higher provisioning even though the underlying circumstances might have improved. Okay, the guidelines also talk about a lot more regulatory backstops. So, I mean, what it means is like, it's not going to be pure replication of Ind AS 109. So, Ind AS 109 talks about a lot of guidelines about how to make a provisioning, but the RBI guidelines talks about a lot more regulatory backstop. Like, for example, in the current scenario in the NBFC space, the NBFCs are required to make provision as per ECL, which is Ind AS 109. At the same point of time, they also need to calculate the provisioning as per the prudential norms issued by RBI. So in case the provisioning as per the RBI norms is higher than ECL, they have to create an impairment reserve, which is more like a debit directly to the reserve and surplus of the company. So that's more like a regulatory backstop, one of the example. There are a lot of other things which are mentioned here under the guidelines, which differ from Ind AS 109, but that's more like the RBI's way to basically ensure that there is consistency in making provisions by various banks. Okay, so ECL models, I mean, are going to be much complex. I mean, there are a lot of models available in the market. The banks have been asked by RBI 3 years back that because Ind AS 109 is already there, they were required to submit the pro forma financial statements to understand the impact that if ECL is implemented in accordance with Ind AS 109, what is the incremental impact? I spoke about distress valuation. I think that's another area where we see a lot of impact. What guidelines say that for the purpose of calculating the prudential provisioning, you have to assume the distress value of the collateral. Whereas Ind AS 109, it basically talks about the realizable value. Now in the practical circumstances on the ground, there can be a lot more differences between the distress value and the realizable value. And that's another area which can actually create a lot more impact. Irrevocable loan commitments and financial guarantees, the guidance says that, okay, if you have sanctioned a loan, even though the money has not been lent to the customer, there also you have to consider this for ECL assessment. So more detailed guidance is needed in this area to figure out how the provisioning needs to be made. And there are few key differences from Ind AS 109, which is more like a regulatory backstop. More guidance is needed to understand how this needs to be implemented. And more importantly, the banks have been submitting the pro forma Ind AS numbers based upon current Ind AS 109. Now the question is that if the RBI discussion paper is there already in the market, do they need to compute in accordance with this paper? And if they need to compute, a lot more guidance is needed for the practical implementation on the ground. Yeah. So, I mean, just a very broad number, 135 lakh crores is the value of the loan book if we put across all the banks together. So there is an estimate done by the Bain and Company which says that because of the implementation of ECL, there will be incremental provisioning to the extent of 4%, which comes out to be 4 lakh crores. So that's one way of looking into it. But when we talk to banks, our clients, what we get to know that based upon the pro forma Ind AS assessment they have done, the incremental impact is not really going to be huge, because if we see the NPA ratio, that's all-time low in the current market environment. The provisional coverage ratio is also all-time high. So in case the Ind AS is really implemented in the letter
Financial statements. In fact, ECL is something which should be followed, even though not required by the law or accounting standards. So with that, it's open for the floor. Any question that you have, please ask. Yeah, please. Can you move with the mic here? Be brief, and the panelists you would like to address your question.
My question is to Rahul with regard to the ECL, that RBI circular on that impairment reserve creation. Suppose the company is actually making a loss. Will the creation of reserve will not be counterintuitive? So can a loss-making company create a reserve?
So, I mean, one, just to clarify, this impairment reserve thing is applicable to NBFCs. When we talk about Ind AS application on the banks in the context of ECL, that's not really the guidance. But if we talk about NBFCs, the underlying intention of the regulator is to basically figure out if we make a provision in the worst case scenario, how the capital look like. So it doesn't matter is it a profitable company or loss-making company. If we see purely from the capital adequacy perspective, are we sufficiently covered or not? So think about a scenario that you make a provision in accordance with a threshold defined by the RBI, it comes out to be 100 rupees. Whereas as per ECL guidelines, it comes out to be 80. So to ensure consistency that when they look into all the NBFCs, they see from the common lenses, they say that, okay, 20 rupees you debit from the reserve so that it is not available for the dividend distribution. And whenever you need to release any money from the impairment reserve, the guideline says that you have to take a prior approval from Reserve Bank of India. So that's the intention based upon our understanding.
Yeah. So I had one question for Sarika. I think Sudipto also mentioned briefly in his talk about the importance of sustainability controls, right? So as far as auditors and preparers of financial statements are concerned, they are normally attuned to, you know, a particular framework, which let's say the ICI had developed based on its interaction with other regulators. How do you see the relevance of this framework when you look at sustainability reporting? Because there could be an overlap of information from a financial to financial information basis, but there could be other information also which may not come from the financial reporting system. For example, the scope 3 emissions, right? Whether I reduce my carbon footprint by using a car or by using a metro, that is again a impact based on a scenario. So I just wanted to have your thoughts on the relevance of a particular framework of control which we all are mostly closer to versus what you could see across in other jurisdictions or in other experiences that you had from a control perspective. Thank you.
Yeah. So being an auditor for past 22 years and now being an ESG professional for past 2 years, I can give you a combined answer to it. I am now closing almost 7 BRSR. I'm assuming that you have seen the BRSR format. So now just focus on the sustainability reporting. Should I stand up? So if we look at the sustainability reporting framework, which is BRSR for the Indian listed clients, it's a combination of 3 major departments. 50% of it is almost SEBI and Companies Act. 30% of it is coming from the HR related data, and rest 20% is coming from exactly the environmental data, what we call as the sustainability, so to say. So there is really a combination and a cohesive effort from everybody within the organization, be it HR department, be it the secretarial department or the finance department. I recently given one seminar in Kovalam that is being organized by IMA. That was specifically for CFOs, how to rope in the CFOs in the sustainability reporting. And we found that almost 30% of the involvement of the CFOs are going forward required to have their inputs and have their connect and their support to the non-financial reporting data, because many things emerge from the finance side as well. So if we talk about the value chain partners, which are my downstream and upstream, downstream, like value chain partners, my suppliers and customers, the basic data emerge from my finance department, the suppliers, the vendors, and similarly the HR related data also, the output of which is used for the financial reporting as well as for the non-financial reporting, comes from and is already embedded into the financial system. So I cannot work in silo for my non-financial reporting, which is my ESG reporting, and for the financial reporting, which is my annual report. So as I mentioned that regulators are also working, embedding the financial as well as the non-financial reporting to have the Indian integrated reporting. For example, if I talk about the CSR initiative, so whatever CSR related data is coming from the requirement from the Companies Act will have all the requirements related to the S part of the ESG reporting at the same place. So whatever initiatives I have taken, what is my regulatory requirement as per section 135, what are my risk and opportunities related to those S part will be given at one place together. So I cannot imagine the internal control system for my ESG related thing separate from which is required for my financial reporting. We have to work together, and going forward, I don't think there will be separate team. These will be embedded and will be reporting vertically and horizontally to each other.
Thank
I
you.
hope that
Thank you.
address.
Very, very appropriately answered. Kaushalji, you want to? Yeah, please give mic.
Just an observation, Dr. Haldia, and maybe Deepa or somebody who's been talking about BRSR. See, the assurance framework has not been defined. The assurance professionals have not been very clearly defined. So at the moment, the expectation is very different. The SEBI's point of view, the conflict requirements and the independence requirements are such that you can't do anything else, in case you're working on the assurance part of the ESG. The capacity building, because it's not just the chartered accountants. SEBI does not believe that the only chartered accountants are capable of doing it. There are many others who can do it. So capacity building and the compliance framework, the way it is being expected by SEBI, I think just a thought that we need to think through and come to some kind of clarifications. At the moment, there's a lot of confusions around this.
Yeah, you are absolutely right, and to the point, as I also mentioned in the beginning, that the capacity building is required, and if you want to remain relevant to the BRSR or sustainability, we need to build that capacity. But then, as of now, the auditors are required to report. Management is required to report, and then the auditors, as a part of the financial statements or the annual report, they are required to report. Now, that maybe for the listing companies, and there are initiatives for bringing out some guidance on the assurance. Now, that being the case, auditors have to prepare themselves adequately as to what the guidelines are, and what needs to be done in order to address those guidelines appropriately. So that's very important point, and I believe that's an awakening thought for the profession. Thank you. And I would not take much of your time before lunch and you. The only thing is that during lunch hour is fairly long for 1 hour. Our distinguished panelists, I'm sure, so many of senior professionals countrywide are present here. You can have the benefit of their presence, interact with them, and I'm sure some of them would be willing to give their contact numbers to you. So later on, you can always find them a call away whenever you have any doubt. Am I right, Kaushalji and Archanaji? Yeah, all of them should be always feel that they are call away, and show all of the panelists here. Thank you. And in any case, Mr. Sudipto will be very happy to have calls, because he will know what is happening and what can make the news. And we also have Mr. Garg. Mr. Garg, welcome you. And he is available. He is an ESG head in a country level, national level financial institution. So he would be able to give his perspective, often maybe frustrating, maybe encouraging to all of you. Thank you very much.
Thank you very much, August panel and chair of the session. By the way, just an announcement in context of what Kaushal sir mentioned about the capacity building. Within the limited resources at this department and ASSOCHAM, we are trying our level best to further add on. And in this order, we have also announcement for the capacity building on BRSR reporting itself. So it's a basically 3 weeks program that will be in subsequent to this particular conference we will be having virtually. So several of the participants who are attending this conference, they have already registered, but in case if you further want to add on your teammates, your subordinates, you can do so. And in addition to that, we have another capacity building program being done in the month of August itself. That's on certification jointly being done by ASSOCHAM and Institute of Cost Accountants of India. That's on anti-money laundering, considering the view aspects that it's not something like that people take it otherwise, that why money laundering should be as a part of the capacity building kind of the program or anti-money laundering. But rather this is more important because you never know that which of your client or related parties involved in such transactions that may otherwise impact it. And real estate sector is really looking at this particular problem as a whole, because even the customers who would have ever bought the or purchased the property in terms of the payment of cash, and now they are being held up and their properties are being seized over. So this is something which is very much important that corporate stakeholders should look into, and their teams can also be, invited to, participate and take the benefit, which is very, very cost effective. We have just charged for this 5,000 rupees for a day-long program, and this will be jointly certified by ASSOCHAM and Institute of Cost Accountants of India. Now, this is just an announcement toward the capacity building that we are having. So, thank you very much, Chairman Sir, for your guidance and throughout this particular conference. And with your permission, if I may invite all the audience, all the participants to please join us for the lunch and come back. And please, we will be starting sharp at 3 o'clock. So, please join us back at 3 for the next session. Yeah. So that's there. A very good afternoon and warm welcome back to ASSOCHAM, Third International Conference on Financial Reporting and Control, Recent Amendment and Challenges. Ladies and gentlemen, now we have this third session which focuses on the other considerations on financial and non-financial reporting, particularly those which could not be captured in the first two sessions, wherein we have session moderator Ms. Archana Bhutani, partner Deloitte India. She will be covering the presentation and disclosure and financial statements, what are the recent developments. We have eminent speakers for the session, Dr. S.S. Garg, General Manager and Head of Department from India Infrastructure Finance Company Limited. We have Mr. Lalit Kumar, he is partner with Walker Chandiok and Company LLP. We have internationally renowned person being faculty for this, one of the being panelist in this session, C.A. Binod Kashyap ji, Director NextGen Knowledge Solutions Private Limited. And we have another speaker for this session, Mr. C.S. Manoj Sonawala ji, Founder and CEO Manoyog GRC Advisors. I welcome all the session moderator and panelists of this session to please join us on the dais. I do acknowledge the august presence of Chief General Manager from NFRA and the officials who are sitting here, joined since morning. I apologize that I couldn't recognize my faces. I'm sorry for that. So now with that, I look forward for this last session for the day. I hope that that will be again contributing towards the enriching of the knowledge on the subject. So I welcome session moderator to please take over and proceed with these panelists in the session. I request Dr. S.S. Garg sir to please come on the dais, Mr. Lalit Kumar ji, C.A. Binod Kashyap ji and C.S. Manoj Sonawala ji. Friends, please welcome all the moderator and session panelists on dais. Thank you, and I hand over the mic to you. So presentations are here only. Yeah, you will start with. IT team, can you please check the display of the PPTs of this session? Is this? Okay, okay, they are controlling from there. There.
No, mine is not here.
Yours is there? When did you send?
Morning I sent. Just check. I'll start.
Okay, okay, okay.
I'll start to check.
Jatin, please check the PPT of Ms. Archana Bhutani ji.
Let me start.
Yeah.
So while the presentation is getting loaded, I'll start in the interest of time. So first of all, a very, very good afternoon, and thank you so much for joining us for the after lunch session, which is usually not an easy one. Really, really appreciate you giving your time. In this session, we will be covering some financial as well as non-financial considerations. The ASSOCHAM has been very nice in addition to letting me moderate, they've been willing to let me steal 10 minutes to talk about certain developments as far as presentation and disclosure requirements are concerned. So while we've had a session on India's developments, I will not be covering what's already been issued. I will just quickly talk about, just in 10 minutes, some of the developments which are under discussion or something that can be forthcoming. The intention is not to make it an educational session. It is just to kind of give you a quick snapshot of what are some of the projects which are in progress, and it'll be extremely relevant if we as stakeholders can participate in submitting our comments, because ultimately these will need to be applied in India as well. So I'll start with that, and then we have, I have my panelists here, esteemed panelist, who will then take us through certain non-financial considerations relating to, your sustainability financing. It is audit quality related matters. We've got management commentary and internal control as well. Okay, so while the presentation is yet to get loaded, but 2 more minutes, that's okay. So if it's okay, I'll just give you a background even without the presentation. Like I said, it's just about a snapshot only. The IASB, if you look at it, has issued many standards in the last decade. However, most of these, or let me put it like this, largely all of these relate only to measurement and recognition. So if you look at leases, you look at revenue recognition, these standards have largely been related to that. Very little actually has been done in terms of presentation and disclosure, and we quite often even talk about disclosure overload and so on, and there are many concerns around non-GAAP measures. There have been many discussions on that. So responding to the investor demand, the IASB has now proposed certain improvements to how financial information will be presented. And when I talk about financial information, the focus of IASB is more on financial performance, which is your statement of profit and loss. So significant amendments or proposals are being finalized at the IASB level, and this IASB is doing as part of their project, which is called the primary financial statements. There are three significant, of course it will be a new standard, so there are many aspects to it, but the three significant aspects of this, thank you so much. So if you look at it, the three main proposals are: one, new subtotals, or let me not say new, subtotals will now be introduced and can be given in the statement of profit and loss. The second is relating to management performance measures, which is what we commonly refer to as non-GAAP measures. And the third is about disaggregating the information. So I will just quickly take you through each one of them. Now, in the absence of any subtotals, in the absence, if you look at the IFRS, the statement of P&L requirements, it defines what is income or revenue, it defines what is net profit or loss, but it doesn't define any other subtotal. That's it. In India, we still have Schedule 3, but if you look at an IFRS, there is no subtotals which are really required, and effectively that makes the P&L relatively free form, right? So investors as well as companies, if you look at it, do have a need for subtotals. It enables them to not just evaluate performance as a whole, but also to see various aspects of performance. And because of that, companies have started using their own subtotals. Say, for example, someone would use an operating profit, which is very common in IFRS financial statements. Now, because, like I said, this is primarily because IFRS does not have subtotals, and each company has started creating their own subtotals. This obviously leads to lack of consistency and comparability. So even if I look at operating profit, if let's say 5 companies are giving a subtotal of operating profit, and you want to compare, the definition or how that operating profit has been arrived at could be different. So you do not really have comparability, right? So one, like I said, no subtotals, leading to each company creating their own, and that taking away their comparability and consistency. And therefore now, IASB in its new proposals, or the new standard, is going to introduce 3 new subtotals, as you can see on the screen. And this will not just provide better structure to the P&L, but it will also help in having more comparability across companies. So that's the first, if you ask me, this is the first very important proposal. The structure which I've just shown you on the slide is like a typical trading or a manufacturing company. The standard also, or the new proposals, will also deal with companies which are in specified business, let's say banking or insurance. So you'll have specific requirements even for those. The second proposal, if you ask me, which is a significant one, is regarding the management performance measures. And like I said earlier, this is what we normally refer to as non-GAAP measures. Now, companies have been using various non-GAAP measures, as we are aware. And once you've got these subtotals which come in the standard, would these non-GAAP measures totally go away? Our expectation is that probably this will decrease the use or the need for the non-GAAP measures, but I don't think we can live in an illusion that non-GAAP measures will totally go away. These measures do have utility, they do provide useful information. And therefore, the objective of the standard is not to root them out, it's not to say we can't have them at all, but it is to see how can we have transparency and discipline as far as these measures are concerned. So, while now management performance measures will be acknowledged and there are going to be specific guidelines for those as far as the new standard is concerned. Now, if you were just to see, like I said, it's all about transparency and discipline, and how would the standard try and achieve that? So let's say if I as a company very usually or commonly give a non-GAAP measure in my investor pack. Okay. Obviously, why am I giving it in the investor pack? Because I believe it is relevant to understand my performance story, the performance story of my company. If that is so, and that is why it is being given, there is a rebuttable presumption that this will constitute a management performance measure for the purpose of this standard. Now, let's say a company gives a particular non-GAAP measure. The standard will now require them to reconcile it to a subtotal of the P&L. So, effectively, that will help the investors understand what really is the difference between a subtotal in the statement, financial statement, as compared to the management performance measure. If I can just show you. So, if you see, this is a kind of, if someone wants to give an adjusted operating profit where they are taking out restructuring, they want to give a profit without restructuring expenses, then a reconciliation will have to be given as to how does this MPM reconcile with the operating profit subtotal in the financial statements. So this will bring in, if you ask me, discipline. The second bit is that all these MPMs will have to be disclosed in a single note. So you can't scatter them, and it will make it easier for the investor to have this information. And let me say, I'm just giving very, very broad points. There's obviously the requirements are much, much more detailed. The third bit is regarding the disaggregation of information. There was a lot of feedback from investors that quite often, information is lumped into one line item. So if you'll pick up a financial statement, you'll have other expenses, and that other expenses will have God knows how many more items, right? And at times that may take away useful information which may be required by a stakeholder. So the standard will now have very specific guidance in terms of how to disaggregate. It could be disaggregating on the face of the statement, or it could be disaggregating within the notes to the accounts. So this will again, like I said, help bring in transparency and better structure and make sure that more relevant information is available to the stakeholders. Yeah, so basically, yeah, the same. And if you ask me, overall, I feel that the proposals are very important. They could be game changer as far as financial reporting is concerned. They will help provide better information. They will also help in companies being able to better explain their performance. Now you may say that this is in IFRS, this is yet to be finalized. Why does it concern us in India? The original ED, actually the first ED came out in 2019. The IASB has done its outreach, etc. Very recently, it has even incorporated many other changes based on the the feedback received through outreach. So some of the proposals which you may see in ED may not be there in the final standard, because some of them are being based on the investor the outreach. Some of them are being amended, but they are going to be relevant, because if we do converge, which is we are on the convergence path in India, if we do converge, this will become relevant for us. Even though we have Schedule 3. Also, please remember that Schedule 3 acknowledges that if the standard has a particular requirement, that will prevail over Schedule 3 disclosure requirements. So it will be very interesting to see how does this pan out as far as India is concerned. Would we have a carve-out? Would we fully converge? And that is where your feedback, at least when the process starts in India, and maybe even right now, why just wait for the process to start in India? Good enough to even start giving the feedback to IASB. So I think this is going to be very, very relevant in that sense, yeah. The next bit, which I just want to quickly talk about in terms of presentation, is the exposure draft, which has already been issued by the ICI. That's regarding the current, non-current, classification of liability, and especially more, specifically I'm talking in the context of loan, which is the current non-classification has been subject matter of a lot of debate there. So if you look at the requirements of Ind AS, it requires that a company should classify as a debt as a non-current if it has unconditional right to defer that payment for more than 12 months. Now in that context, if you look at the application or implementation in India, there's been some bit of lack of clarity, some implementation challenges have come up, and considering that, the standard is being revised. The first bit, if you ask me, there are three changes. The first bit is actually convergence with IFRS. So I mean, these issues were not just in India, but even globally. And IFRS, or let me put it like this, IAS 1 has already been amended. So India is now converging with the amendments in IAS 1. The second is we do have a carve out in India in terms of, I'm not going through the whole technical language, but in case of a loan default, default of a loan covenant, if there is a breach and it gets condoned by the time the financial statements are adopted, you do have a carve-out. The ED proposes the removal of the carve-out. So that's a very big significant change. And the third is, of course, on the applicability date. I'm not so concerned about the third one. I'll quickly on the first two, at a very broad level. If you ask me in terms of what is the impact of the changes, in terms of the convergence with IAS 1, I think they're largely clarificatory, but like I said, largely, okay. They do bring in some changes because of the clarifications which are coming out, because earlier the implementation, there could be some diversity. So right now the requirement in the standard is for something to be non-current, the company should have an unconditional right to defer. That term unconditional will be replaced by the right having substance. So that again will bring in some level of judgment. And there's some reconciliations in the sense there was some inconsistency in the drafting of the paragraphs to this effect of current, non-current. That's been sorted out. The third bit is, when a loan is subject to a loan covenant and you have to look at current, non-current classification, questions came up, which are the kind of covenants do we look at and how do these impact classification? So there's going to be much more clarity on it. Effectively, if a covenant is to be tested on, it has to be met and will be tested on the reporting date, it will impact. If it is to be met after the reporting date, then it will not have an impact on the financial statements, on the classification, sorry. So let me just quickly take an example. Let's say my debt covenant says that I have to have a current ratio of 1 as at 31st March 23. So that would of course impact my current, non-current classification on 31st March 23, even if the bank is going to test this compliance say in June. It doesn't matter, but if it has to be met on 31st March, it will. But let's say if I have a loan covenant, which is that current ratio to be 1 to be met by 30th of June 23, then of course it will not have an impact. But a very, very interesting change which the standard is bringing in, they're saying, listen, the covenant is to be met after the balance sheet date. But you as a company are aware that there is uncertainty in meeting it. Chances are you may not meet it. So it is obviously if you look at transparency and good governance, you should let your stakeholder know that there is a covenant, though it is to be met later, there is uncertainty in compliance with that, and therefore now disclosures will be required. So it may not impact your classification, but it will definitely require certain disclosures. There are also certain clarifications in terms of what would constitute settlement of liability. I'm not going to get into that. And the last is, like I said, the removal of carve-out. While the institute did recommend in its draft the removal of carve-out, if you look at the outreach has given very mixed results. Many believe the carve-out is working well, in substance it gives a good outcome, what is the need. The other side is, the flip side is that, from a financial discipline perspective and from a convergence perspective, should we really continue with this? I think if you've not submitted your comments, I would still suggest, while I know this has reached nearly the final stage at the ICI and probably then we'll move to NEFRA, but whether this carve-out remains or not will be very significant. But let me also put it like this, even if the carve-out is retained, right, what is going to be made very clear is that any breach that you had during the year and was condoned, or you had the breach at year and it was condoned, whenever that breach happened, disclosures would be required. There is already a requirement in India's 107 for such disclosures, but I think everybody's kind of missed it. So that is going to be reiterated. So you may have the carve-out going out, which will have its own implications, but let's say if overall carve-out is retained, even then very specific disclosure requirements of the condonation would be required. So that's what I had on some of the significant, like I said, developments which are in progress, and there are many other. MPV in the morning did refer to IFRIC agenda discussions, etc., and other amendments. So if you see, there's plenty happening at a supplier financing arrangements, and many disclosures will come in there. One trend which I've seen, and I think that's maybe for NEFRA also to consider, is what ISB has been recently doing is wherever there is a very complex, implementation diversity, let me put it like this, their immediate answer is to just give more disclosures rather than to really say, okay, what is the accounting? So we are seeing more and more disclosures actually coming in through some of the issues which are getting escalated to ISB. So that's what I had. I'll hand over now to Mr. Do you have a presentation? Okay. Okay. So I'm going to hand it over to Mr. Manoj Sonawala. He's from Manoyog GRC Advisors, and he will take us through his thoughts on management discussion and report analysis. Thank you so much.
Good afternoon. First of all, let me thank ASSOCHAM, especially Mr. Parasar, for inviting me and be among this August gathering. I have been given to understand that you are professionally acclaimed and very interactive audience. So first I will say what all things I will cover in my discourse. When I say discourse, आपको सब दिल्ली वाले ज़्यादा हैं तो प्रवचन शब्द समझते होंगे. हिंदी डिस्कोर्स का मतलब होता है प्रवचन, और प्रवचन का एक ही फंडा है, बाबा लोग करते हैं, आप सुनते हैं, जितना चाहे वो लो जाओ घर पे, नहीं चाहे तो यहाँ छोड़ जाओ. करेक्ट? तो ले जाओगे तो आपके लिए अच्छा है, नहीं ले जाओगे तो मेरे लिए अच्छा है. सो MD&A what I am going to cover is exactly the same Baba का प्रवचन. So this Manoj Baba is going to give you that pravachan. If you like it, take it. If you don't like it, keep it here. Right? With that disclaimer, I am going to tell you what all things I am going to cover. In MD&A, there is management disclosures and analysis, management discussion and analysis. You what and why you have to disclose and what you have to disclose. And there are statutory references which I will talk about pertaining to Companies Act, listing agreement, LODR, and then I will be talking about what all things you can include, how to approach regarding preparation of the entire MD&A, that is do's and don'ts, and I will tell you the best annual reports also available in the last year. Since I have a flight early, so I have to leave by around 4. So if you have any questions, even only after my presentation is over, you can please raise your queries also pertaining to that. I'll be happy to answer that because I will not be available at the last Q&A session. So I have taken that permission from the management and also from my panel members. That is my madam. Now M&A, why and what. So see, if you see what all madam has said regarding MPM, regarding IFRS, gap arrangement, integrated reporting. See, there are various reports which you need to prepare, and on top of it you have MD&A, right? Now why this MD&A is crucial or important for all the management? Because everywhere pertaining to your IFRS or gap arrangement or LODR, things are codified. You are in a straight jacket. What all things you have to represent or speak about is very well given there. So you cannot deviate much. There is no much scope about the deviation, because the more you deviate, the more you will be questioned. Here in MD&A, the management has an opportunity to clarify or give further kind of an information pertaining to the company regarding their forward-looking businesses, their other things, clarification regarding positive or negative developments in a nutshell. So this is a kind of an outlet which is made available to management for creating a space where they in turn can communicate clearly with the stakeholders. This is what is MD&A is all about in a nutshell. Now, see, this MD&A is a section which is in the annual report, in which the company's management discusses the company's performance in the current year and future outlook. Now, try and understand, this is non-financial, it is not quantitative, it's a qualitative report which we are talking about, right? So, when we are talking about a qualitative report, there are no codification required, and there is a very chances of you giving best of your inputs or information to the stakeholders. Now this is as I said, it uses qualitative and quantitative measures combined. See, when you are talking about qualitative, it has to have some base, which is your quantitative financial reports. But this allows investors an insight into the details that otherwise wouldn't be available or cannot be interpreted just by going through the financial ratios or financial details. Now, it includes, see, MD&A includes macroeconomic performance that could affect the industry in which the company is operating, and thereby the company, its strategy, its vision, their key financial indicators compared to the industry and compared to the entire economy, the rationale and analysis of the same. It also gives management an opportunity to explain why there are variants, both positive or negative, occurred and what they expect from the market. That also can be explained in this MD&A. See, there is, I am sorry, but I don't think anywhere in any of the reporting this facility is available where management can talk about the macroeconomic scenario, the industry scenario, where they can compare their output or outlook during the year coming forward. So it's not about the finance, it's not just about the financial performance, but every factor fundamental to the company from HR to operations are given in that MD&A report. Now, if you go through that, see, what can be covered under the MD&A. So it is, as I said, management's opportunity to explain why variance is both positive and negatives and what they expect from the market. Apart from that, management uses this report to explain the results of operations, can explain unusual events, material transactions, or significant economic changes. The company often uses this opportunity to explain why net revenues and expenses varied from expected or budgeted financial plans. Now you will say, okay, in the board report also you could have given, but there are certain limitations in the board reports because board report has been given certain things that you can in the board report you can include certain items only. So over and above, if you want to go and explain the stakeholders, here there is an opportunity to do the same. Now this section is often used to highlight management estimates used for accounting practices. Some accounting rules require professional judgment. Management can explain why they valued capital assets or inventory or other assets as a certain amount. Now these also can be available in the auditor's report in some notes. If you cross tally, this can be made available by the auditors in some of the notes, which will be not very easy, or approach wise it is not very conducive for the general public to understand the things. But here the management has an opportunity to explain over and above what auditor has written in its own jargon. You know auditor's jargon, right? We all know. So this management has an opportunity to explain further over and above whatever has been explained by the auditors. See, no bad remark for auditors. Auditors are doing their job, which is very difficult. We know in this scenario where everything has to be disclosed transparently and whatnot, and they have to look at the various factors also, and most part is time constraint. So every quarterly management may be on the tenterhook, but the auditors are more nowadays. We know auditors is more towards explaining why they are doing so things. So due respect to this fraternity also. Now, when I say further, see, this base part of the M&A is that is not audited. This section or this report is not audited, and it represents thoughts and expression of management. These statements are not typically authenticated by auditors. This is not, so this is out of the purview of the auditors. Then MD&A is used by management to invoke confidence of investors by explaining how and why future plans of the company will be successful. This is a possibility where they can trade. Now I'll come to the pitfalls also, because everything what just now I am talking about is all goody things, but that is not the all, because when you are having certain liberty comes with lot of responsibility also. I'll explain that responsibilities later. So MD&A section provides an opportunity to the management to discuss directly with all the stakeholders, and this opportunity is less helpful if the management shy away from revealing its forward-looking plans, which does not otherwise attract mandatory filing. Now be careful while you disclose something in the MD&A report. Now if you disclose something which is otherwise UPIC, that is unpublished sensitive information, then you may attract penalties. So don't go overboard in disclosing or putting your future plans or strategies in place, especially when you have not disclosed the required things which you are otherwise supposed to disclose. So you have to be little careful about what you are disclosing in that. Again, the MD&A is important source of information for analysts and investors who want to review the company's financial fundamentals and performance beyond the numbers. See, try and understand. MD&A is, as I said, it is a subjective. It is not a kind of a quantitative. It is a qualitative report. So it has to be little away from the financial reporting. Now, I'll give you a kind of a reasoning why MD&A report is required and statutorily required. Section 134 of the Act, of the Companies Act, deals with the important reports and documents required in a company like financial statements, board reports, director report, responsibility statement, etc. Among that, one is MD&A report. Then Regulation 34(2) of SEBI LODR provides that the annual report shall contain the management discussion and analysis either as a part of director's report or as addition thereto. So we have a requirement under various acts, SEBI LODR, listing agreements, that we have to provide this kind of a report. Now, as I said, MD&A report has to be as a part of the board report or it has to be annexed to it. So there is freedom. Though it has to be attached or it is part of the annual report, but there is a freedom. Now, MD&A report should either form a part of the board's report or be given as an additional there into annual report to the shareholders. It has to be the shareholders. Now, when we say shareholders, it has to be amended to stakeholders, because everybody looks at it. Right from the NFRA, like agency like NFRA, SEBI, stock exchanges, monitoring agencies, and analysts and investors. So all are looking at it. So you have to be very careful while preparing that. Now, MD&A report should be considered in the meeting of the board and not through resolution passed by the circulation. There are requirements for that. So under Companies Act, this is one of the requirement. Now it is desirable that MD&A report is signed. Now word desirable. There is no codification who has to sign, where has to be signed, how it has to be signed. But it is desirable that MD&A report is signed in the same manner as in the case of the board's report, because see, we are giving equal importance or more importance to MD&A report equivalent to board report, because it is from the management. Now it is not from the board. See, there is a difference between board and management. I need not explain to this August gathering the difference between board and management, right? So I'm going ahead with that. Now, Regulation 34(2)(b) of LODR, subsection E requires management discussion and analysis report either as a part of director's report and or addition thereto. Now, if you go through the Regulation 34(2)(b) of LODR, then there are requirement of audited financial statement, consolidated financial statement audited by statutory auditors, then cash flow statement, director's report, and now on the top of it, for the top 1,000 listed entities based on the market capitalization, business responsibility and sustainability report, that is BRSR, on the environment, social and governance disclosures in the format as may be specified by the board from time to time. So again, all these reports are formatted, codified, and you cannot deviate from the requirements. Only MD&A gives you not so straight jacket where you can put your thoughts and ideas to convey it to the stakeholders. Now, in Schedule 5 of SEBI LODR, this section shall includes discussion on some of the matters within the limits set by the listed entities' competitive positions. Now, try and understand, I am talking about the limits set by the listed entities' competitive position. That means, based on your company's scale and size in that particular industry, you have to make disclosures or statements. You cannot make disclosure or statements which are otherwise not in your purview or which is not befitting your size and scale. Right? So if you are a small scale industry, you cannot talk about the high scale industries in your report because it is irrelevant. It doesn't give any kind of a information or kind of a weightage. Now, if your business is local or national, you cannot talk about effects of the bilateral treaty agreements. So you have to be careful what all things you are giving. Now I have got 2 minutes, so I'll quickly run past through my presentation. You have to give the opportunities and threats available to your company, then segment wise or product wise information. You have to provide in that MDN report your business outlook. Then you have to talk about risk and concerns in the your report. You may say internal control systems, which our friend Mr. C.A. Vinod Kashyap sir is going to talk about, and adequacy with no relevance given risk management, then discussion on financial performance with respect to operational performance in a words. Now, these are the things which you need to give. There are various ratios, and if there are variance more than 25%, you have to give a disclosure for that. Disclosure for accounting treatment, this is one which is very important, where in the preparation of financial statements, a treatment different from that prescribed in an accounting standards has been followed. The facts shall be disclosed in the financial statements together with the management's explanation as to why it believes such alternative treatment is more representative of the true and fair view of the underlying business transactions. I am sure statutory auditors will be requiring or making them to do certain disclosures in this fashion, in this requirement also, but there is a possibility in MD&A. Now, I'll talk about why this MD&A is important for you. Once again, that a communication is straight from the management to the shareholders. It gives a bird's eye view of the entire business ecosystem, a narrative of the company and industry in which it operates. It allows investors to ascertain the company's performance and its likely growth. One of the most relevant sections in the annual report that allows investors a chance at analyzing the company. Now, this is an opportunity to offer unique insight into the company for current and future stakeholders. Now, how you will approach an M&A draft? Go back to the whiteboard, recap a year gone by and way forward, your CSR, ESG initiatives, you discuss each and everything minutely with the management and the executive position people in their company so that you can highlight key developments, understand aspects that affect or influence the business. You reread. You cannot see, sometimes if you read the annual report, you will say after 2 years also people are talking about the pandemic, same thing, copy paste. So please don't copy paste. It has to be a relevance. So keep your control C and control V at bay so that you can then prepare a very good report. In fact, there are only 5 don'ts or 7 don'ts which I am going to take and close my remarks. So don't make repetition in your report. Don't cut and paste. Don't use all data from the industry reports. Don't go for political undertones in your MD&A reports. Don't use flowery language. Don't overpromise. Linking to the other documents, if you have to require, please disclose the resources. And stating the obvious is most important because you have to convince the stakeholders. Avoid any negative commentary. Divulge any confidential contractual information only if it is required. And suppress important data and information because your competitors are also seeing these reports. Thank you very much.
before I make some comments, are there any questions from the audience? No, because he has a.
Yeah.
So I think for this one, we'll do the question Q&A now. The others we'll do after the session.
It's not a one person's job. Even if it is prepared by company secretary, he has to start preparing on the incident wise, event wise, and he has to get involved all the management people together, because it's not a board's report, it is a management report, and management includes all the executives, your production in charge or marketing in charge. So it has to be prepared by anybody. Even if it is a company secretary or compliance officer, he has to take cognizance of all the inputs from all the people possible.
I found the session very interesting, and I think, like Mr. Sonawala pointed out, it is about management telling their story. And I think it's not just non-financial. Frankly, my take is that this is equally relevant to us as auditors. There could be so much information in that MD&A which could help us better understand. I mean, if I'm a stakeholder, reading the two together can help me better understand the financial statements. And of course, this would also give me lots of information as far as my estimates, my, many other financial statement items are concerned. And even from an SS 720 perspective, the way I see is that the information which is there in the MD&A would become very relevant to see whether there is any inconsistency with the financial statements. And just on a very lighter note, this was an example some other panelist in some other session had shared. And they said, the board report started with saying the future outlook is very gloomy. But when you go to the financial statements, the estimates, and there's no impairment, the estimates are very aggressive and so on. So just on a lighter note. So I think, yes, it does offer a lot of information, very valuable.
So you have to be very careful. See, as I said in the do and don'ts, see, you have to be consistent when you are saying. So this year you have said something, next year you cannot change your goalpost and do something else or say something else. So you have to be consistent, because see, this is a one communication which gives you a kind of an opportunity to build your image in the long run. So you have to be very careful. See, this is not a report which is like a tick mark box kind of thing. So it is very subjective, it is very qualitative. You have to be very careful while preparing also and while submitting also.
Thank you. Thank you, sir.
See, while having lunch, she was asking me about is there any provision which I will be taking up in ACC regarding 10Q and 10KA and all. Due to time paucity, it is not been taken over, because ACC also, there are requirements pertaining to MD&A, and they have codified so many things, and they have given very clear ideas under 10K and 10QA format. So if anybody wants to understand more about the ACC requirements and all, you can directly get in touch with me. My email can be shared by Mr. Parashar. Thank you.
Thanks. I will now request Dr. S.S. Garg. He's the General Manager and Head of Department, India Infrastructure Finance Company Limited. And I understand he's got if I go through his profile, it's a very vast one. So I'm not going to attempt to even do that. I'll request you, sir, to just take us through the discussion on role of financial institutions in sustainability reporting.
Thank you, and good afternoon to all of you. Basically, sustainability is a very comprehensive and vast subject. It's not, that when we talk about, especially in financial institution, and the role is very, very important, that to integrate the things. Before that, I just, talk about some, like my IIFCL, that's the company I'm working. IFCL basically it's a NBFC. This was established in 2006 onwards. So now it's a 17 years old, wholly owned Government of India organization, which is basically lending in major infrastructure projects. And so far it is around 700 plus projects we lended, and around 2 lakh crores of sanctions and more than 1 lakh crore disbursement in last 17 years. And if you talk about the sectors, so it's that mandate is given as per the safety. So mostly, that all the sectors you can say it's around 34 subsectors. Roads and highway, energy, transmission, ports, airports. So all mixed type of, now it is last 2 years it is added the social infrastructure also. So that is also one of the area we are covering. So the basically that, and we have a few different line of credit from the different multilaterals. So that is one very important aspect, and that is around 3 billion of USD line of credit from different MDBs. That is the like World Bank, ADB, EIB, JICA, KFW. So these are the line, and these line was basically given to IFCL to that you must have your capacity on sustainability and environment and social safeguard. So that's why I am here basically. This department was ESMU set up in 2010 onwards. I worked in almost 20 years in private sectors in different groups, that Jindal and all. So when I joined, this was basically, that's why this was the one of the requirement that you must that integrate, because IFCL is basically financial institution. So they don't have much capacity on the sustainability and all. So that's why this was created, and we have a very small department that we call Environment and Social Management Unit, and where 4 or 5 people are there from different backgrounds like environment and social, plus 25 or 20 years experience on that subject. So we frame the that ESSF, Environment and Social Safeguard Framework, which is that required to do the very detailed due diligence for each line of credit, not only line of credits, each projects you can say. So it's a very detailed that due diligence, starting from the lending itself and till the exposure, and exposure is very high, like that infrastructure projects are 20 plus years or 25 years. So you need to that integrate all the things in a way that how you can monitor the project, whether you are how you are impacting the that ESG, because now we are talking about ESG, and when I joined in 90s, that there was no concept of ESG, although it's what in scattered way. But when we talk about environment and safety, then EHS, environment, health and safety, then HSE, environment, health and safety. Now it's a new terminology. It's not new, but it's now ESG we are talking, environment and social governance. So we are very much that I can say that's the regulatory part and are very vast and very good in India. It's not like that World is only having, or World Bank is having, or ADB is having. We have very good framework. We had started 1974 Water Act, later on 1981 Air Act, then EPA Act 1986, then EIA Act 94, then new versions 2006. So there are a lot of that regulatory framework is there. But only thing is basically how that we implement those requirements, because why this need now? Everyone is talking about the ESG, and why this now? Because now we are in very that in that stage we cannot afford now to more on carbon and this one. So now we are talking about the zero carbon 2070, 2035, 50%, like that. Everyone talking. Lot of work is also going on. Lot of that things to be done. But basically that's why I'm saying this department was created through the help of World Bank, and World Bank has given lot of comfort on that. So we had policy that is approved by the board and different multilaterals. So that process is there. How that you take care of each and every aspects of environment and social safeguards, and how we align with the requirements, those requirements in the lifetime of the projects. So it's not only the that tick mark or something like that. It's very detailed due diligence. You have to see each and every aspects of environment and social. You have to see visit the site visits, see the impact, see the that whatever compliance level at site level. So that is also, and the multilateral also that visiting the projects time to time and see the, that how we are impacting on those aspects on positive way. So these are the things basically, this, and then every year you have to do the audits also, ASMR that we call, annual environment and social safeguard management. So that is also required. So this the very, detailed framework is there, and the disclosure, one of the most important thing basically, we have to disclose each and everything in the website itself, from the multilateral and in IFCL website also. So you can see all the projects, all the, the disclosure is there in the website, and you can see the, if you have anything or any adverse or something like that. And because, that challenges are there, people don't understand now. And but today also, I was having one conference in Lee Meridian last month, I think 6th of June. I invited one of the member secretary from the Pollution Control Board. It's a live example how we are thinking, how, that weightage we are giving on that one. So I'm not disclosing the name, but one of the group was hotel chain, international hotels they had set up in the Dehradun somewhere. And he just called the member secretary, sir, I want to meet you regarding something. He says, sir, I have some site visits and all. So no, we have very important and we have to meet it. Then he cut short his visits and visited his office. The gentleman came and just saying that tomorrow we have the, that opening of our hotel and CM is coming. So we need this environmental clearance for this hotel. So he was asking, had you applied the environmental clearance? No, we don't require that things. Because CM is coming, so you have to give the paper because we have to show him, otherwise how we can So you can see it's not a lower person or some middle person, it's a very top people who think about the this thing. And later on this hotel was not inaugurated for 2 years. Because it's not a one-day job. You can take the environmental clearance from the printout and give it, your environmental clearance is granted. It's a process, it's a procedure is there. You have to apply, you have to see all the papers whether it is aligned with that or not. So I'm giving the example today's environment even, people how that seriousness is there on that. We all about talking about this one ESG reporting and all. It's not like that reporting where you have done a tick, air pollution, water pollution, this, noise, this, that. This is not like that. It's a very detailed subject. You have to have the expertise in that. And otherwise, this impact will, that increasing day by day, it's not so easy to handle. You are talking about 1.5 degrees centigrade temperature, and every time we are talking about, that global warming and this one. Today we are talking somewhere a flood is there, somewhere drought is there. It's not a one-day job. It's a very cumulative impact. It's a 10 years, 20 years, 30 years. So that need to be, that role is very, very important of all the, not only financial institutions, all the lenders I can say. Even though I was talking with the ADB, why not you have some penalty to the bankers or lending agency if they are not monitoring the sustainability properly? Because they are also responsible for that. That's only not the industry or something like that, they are not reporting on that. Financial institution or bankers are much more, that they have the role on that. To see the gravity of this important aspects. So that is also there we have to that think over that this cannot be now ignored no more. We have to take the action. We have to have that seriousness thing. And thank you, I think SOCM that conducting such that wonderful workshop. So to know that to elaborate, to think over and these aspects, and so this is how much that, because it's not a one-day job or something that we know that what were the water quality was there, what were the ambient air quality before that, now in which situation we are there. Nobody can now afford, nobody was thinking that we will drink water in the bottles and all like that, in India especially. If you talk 30, 40 years, 50 years back, people will laugh. Water we will drink in bottle. How it is possible? We are talking the ambient air quality everywhere. Delhi, they are saying, oh, this is the ambient air quality criteria, parameters are going so high and all this. So we have to take the responsibility, and that I'm saying. This is not the one person job or something like that, but it's a cumulative impact, and we need to have the things. Now, many organizations, SEBI has come with the regulators and all, so this is also required to disclose the things. But my question is basically, this is implementation is very, very important. Only, that putting the note or in your website or your this annual report is not good enough. We have to think on that. We have to show our seriousness and implement the things. So that is the important. And I have not taken the presentation because it's a very, if you talk about it, say, you can talk 2-3 days continuous in the sustainability. So it's a big subject, but I am happy. I am working I am here, my office is there. If anyone, that want to work on that, want some suggestions or something like that, I will be happy to, that share my experience and how we can do. I work almost 250 projects so far in different things, and working last 10 years with IFCL. So I have written a number of papers and research papers also, visited so many countries also, to see how they are implementing and things. But everyone is looking for India. Nobody, because we are now, because contribution is very high. We are 150 crores. So everyone is thinking, oh, India will do something. US will not do, China will not do, other countries will not do, but they will do. I am just concluding the sense, but basically when I was in China, because they don't have regulation. They have the, that if they want to development, they can cut anything. Rato-rat, they will just destroy and put the industry on anything. But impact, if you're talking, there's a global impact. It's not only the China is limited, the impact only the China. Its impact is to the globe. Everyone is affected. So we need those aspects also. Now everyone, now it's world is very small, today's environment. So everyone, every country, every person needs your contribution, commitment towards the sustainable development. Thank you very much for inviting. Thank you.
Thank you. Thank you. And if I may take the opportunity, I recently, Mr. Haldia had shared, Dr. Haldia had shared his article, and I found that very interesting on sustainability financing. If I can just quickly share, I think he very correctly pointed out, it is going to become it has actually become a business and a strategic imperative. And some of the challenges, I think, which is what Mr. Garg also pointed out to, is challenges in terms of setting up the KPIs, implementing or monitoring those. And I think that's further accentuated by the fact that there are no best practices so far. So I guess I thought that article captured these issues very well. Yeah. We'll move on. I'm going to invite Lalit Kumar to speak on audit quality implications of recent NEFRA orders for the audit firms. Lalit is a partner with Walker Chandiok and Company LLP.
Yeah. Wow. And this is working. Yeah, it is working. Right? Yes. Okay. Post-lunch session, audit quality. Right. And the topic is NFRA orders. How does it impact? Or what are the implications of? Actually, I mean, the quote that you see on the presentation is a very well read, well heard, well talked about quote in the quality world, which means doing it right when no one is looking. Henry Ford. This is what by Henry Ford. Profession has been like that for many years. There was no one looking, and we had ample opportunity to do it right. And perhaps we always believed that we are doing it right, because no one else other than us looked at the work that we were producing. There is a lot of good work that all chartered accountants firms do. Can we say that there is no scope for improvement anywhere? I think there has always been a scope for improvement. There will always be a scope for improvement. Who tells us those improvements? Right? We or somebody else. It can be anyone who is using your report, who has an observation, should be able to tell you, look here, I feel this is not right. As a responsible profession, it is expected of that we will look into what went wrong. Right? The institute gave us the framework to have a system of quality control which had certain components. Everything revolves around that system. If your system is working absolutely fine, there is all the chances, there is everything that is possible is that you will produce the right quality of work. But like any other system that operates in this universe, in this world, there are aberrations that may arise. Right? And the responsibility that the system casts on the firms is to test your own engagements, to test your own systems, to see, are there aberrations? Is there something that you need to correct? If yes, remediate that situation. Understand the root cause, remediate that situation, and then again go for inputs, process, produce quality output, again test. This is a cycle. It is just that we have now a regulator who has started giving out their own perspective on the work that we are producing by looking at the work that we do, the papers, the documentation which we ourselves were looking into, NFRA is there to look into. What does it mean? What implications could be for the profession? There is no one right answer. There are different perspectives, there are different scenarios, there are different aspects with which these findings can be looked at. Right? And I was struggling when I was compiling my thoughts on how do we talk about it, how do we build a discussion around it, because I would want to have questions from you to talk about. Less, preaching, I would say, and this is purely my perspective. There could be many more perspectives to this. Right? If you look at NFRA orders, one topic that they have picked up is ethical requirements, and there are variety of findings. You will see the company did not take 144 approval, the auditor rendered services that were not prohibited, the auditor failed to consider all the relationships when they were evaluating non-audit services, whether it is permissible or not. In some cases, it has been pointed out that audit team had to be rotated because 7 years had completed, but it didn't happen, right? Now, what does it mean for a chartered accountant firm, for a practitioner? What implication does it have? One thing that is for sure, is an opportunity for introspection. Opportunity of introspection from where these findings are coming, and I tried to arrange my thoughts in the sequence. If you see the first bullet on the right hand side of the slide says tone at the top. If any of this has to happen in a firm of chartered accountant, the first thing that we need to see, or when we do our introspection, we need to take is the tone of the top aligned? Are we giving enough messages to the people who are working in the firm that make sure that you are always complying with the relevant ethical requirements? If that is there, the second question that comes to your mind is, did people on the ground understand the requirements? What really is required under the standards to be done? If you believe that you have imparted enough trainings within the firm and your people are trained, then are there enough policies and procedures that people are required to follow? And these policies and procedures could be related to identification of relationships between what all entities you will cover in your independence analysis. Do you have policies and procedures for evaluating non-audit services? Because there are a lot of judgmental factors. Don't be afraid of how NFRA interprets, right? But make good decisions, make good professional judgments. Should have policies for ethical consultations. If somebody is in doubt within the firm, he is able to go back to a person who specializes in that subject and possibly give you a consultation. If all the 3 blocks are ticked, then possibly look at if these findings are there, did we have enough people to take care of these aspects in an audit? And if not, I mean, please fill your people, hire, but make sure that you are not doing unfit hires. Make sure that your policies and procedures have they reward and recognize quality work, and people are held accountable, right? These sound like solutions, but to me these are implications also. I mean, when I say introspection, what do you introspect is the implication when you look at these findings. When we go to the engagement, specific things, there are matters related to related party transactions, communication with those charged with governance, audit of estimates, robust risk assessment. So you will find commentary or findings in NFRA orders about these aspects. But these are the aspects which NFRA has looked into, right? And if we again look at possible indicators why this could have been there in an audit, the first 2 blocks remain the same. The policies and procedures, I think since they are more related to performance of engagement on the job, again an introspection, do you have policies and procedures which deal with direction and supervision of work, which means if somebody worked on audit of estimates, was this work reviewed by somebody very senior in the audit team to come to a conclusion, yes, that the assumptions used by the management are reasonable, right? Or the people who are working in your audit team, did they have enough time in hand to do the job? Could they discuss important issues with their seniors in the organization, right? Do that introspection. If there is something lacking, please think of correcting that. I think the last 2 bullets also remain the same. So it's really the possible indicators, and these indicators, while I'm talking about the indicators, these indicators are, like I said, my perspective, right? There are many more perspectives that you can see from where you are in the profession. EQCR not appointed, or EQCR did not give enough time, or was involved at the last moment, or there is not enough documentation on the file that EQCR really actually did review. What questions did EQCR? All these questions have come up in NFRA findings, and again, possible indicators remain the same. The only thing that I've changed in this slide is which policies and procedures it indicates could be lacking, which means you may not have a policy for appointment of EQCR. You may not have laid down a policy on how EQCR will document their work, or you may not have a policy on how you're going to deal with differences of opinion, right? But these, I mean, we can go on, but if we try and link to see what are the immediate possible opportunities if a chartered accountant firm has to really look into these orders, and I would say the first top priorities that comes to my mind that firms should look at, right, is tone at the top, build quality oriented culture within the firm, fix accountability and have sufficient resources within the firm to do the engagement. Make sure that you are able to identify all the relationships that you need to when you are doing your independence checks. Be very careful when you are doing non-audit services. Make sure that they are permissible not only under the Code of Ethics but also under the requirements of the Companies Act. Client and engagement acceptance, human resources, all these are mainly related to the methodology. You should have fit people on the team. They should be trained very well. They should be evaluated properly, and good quality work should be rewarded and recognized. Make sure when you are doing your audit methodologies are updated for changes in the standard. It may be related to accounting or auditing both. There is the documentation requirements that are complied with. You should have consultation policies. And of course, irrespective, I would again say what is there in an FRA order is absolutely fine, but carry out your own self-assessment. Check your own engagements. All this is required under SQC 1, right? Test your system of quality control. See where the aberrations are coming. What are the causes? What are the possible indicators? What are the things that you need to do to make sure that these things are eliminated? Solutions, not definite. Like I said, it would be situations, but the larger implications for the audit firms today, when we talk about it, we need to change the approach, right? Profession has been in a very comfortable position with no one looking at. I think it's a very good opportunity for the profession to take what someone else has to say about the work that we are producing. Do not think, go about that we will take care of what is coming out in NFRA orders. No, there could be other things that you may be lacking on. When NFRA comes and examines your engagement or your firm, there could be other things that may come up, right? So be conscious of the system of quality control, be conscious of what as a firm is being produced, right? Definitely the implication that currently I am experiencing when I talk to people, my colleagues, aspirants, younger generation, I think they are feeling insecure, right? They want psychological safety. And the only message to young chartered accountants who are not yet partners or may not be exposed to NFRA audits is, do your work properly. Do your work properly. If you are not able to comply with any standard, raise your hand. It's your firm's responsibility to make sure that arrangements are made, standards are complied with. Unless you have done something ethically wrong, I firmly believe NFRA is, I mean, it's entirely their judgment, but I believe it would not be as punitive as you might think, right? Lack of talent is what the firms are experiencing, because the aspirants who, I mean, there are a lot of people who are doing chartered accountancy. If you interview them, how many of them want to become a partner in an audit firm? You will not find many people. We are struggling because they simply are not interested. For firms, the cost is going to increase. There is cost that you are required to pay to good chartered accountants who are ready to practice. There is cost that you are incurring to pay your lawyers to deal with NFRA. There is cost that you are incurring to, keep your client data confidential. There is cost that you are incurring to fill up the returns that you have to file to NFRA. There is cost that you are incurring for any information, because if there is a file that needs to be inspected, there are tons of information that is required to be incurred. So all that is translating into costs. It is a serious business. So I think fees, right? Do not simply quote a fee lower than what your competitor has quoted. Have regard to your costs. You want to deliver good quality, you will have to incur good costs and have to charge good fees. Why can't we get paid as the lawyers are paid? Ask for that fee, value yourself. The country will value your services, right? I think that is all I had to say. We'll be happy to take questions. Thank you so much.
Thank you, Lalit. I'll now invite Mr. Vinod Kashyap. He's the director with the Next Gen Knowledge Solutions Private Limited. He's going to be talking about adopting internal controls, safeguarding financial reporting in the digital age. So I've reserved my comment for the session that Lalit took, but by the time Mr. Okay, yeah, maybe we'll do that.
Good evening, everyone. We are in the last session, so I'd like to finish it within the time allotted to me, which is about 10 to 12 minutes. Though I can speak on this topic for an hour together and it requires more time, but due to time constraints, I'll try to cover some of the key points in my presentation: adapting internal controls, safeguarding financial reporting in the digital age. Internal controls, I don't need to elaborate much upon it. You all are familiar with testing internal controls for a year. These are basically the activities which overlay the existing process, which are employed to basically safeguard the assets, to ensure the processes which are designed, which are prescribed, they are followed, errors are not there. So that is the basic objective. And straight away I'll come to the point: what happens when there is lack of adequate internal controls or there is internal control failure. See, these are the examples. Some of the names you will be familiar with. Satyam, sorry, there is a typing error. Satyam Computers, then Rico India, Punjab National Bank and FTX. FTX is a global name, I don't know how many of you have heard about this story, and I will try to talk about two cases. One is the Punjab National Bank, which I'm sure you all must have read about it in the newspapers. It was one of the biggest fraud in banking industry, involving almost $1.7 billion, and it spread over between 2011 to 2018. And RBI came out with its finding, and they found two main reasons for this fraud. One was there was involvement of one or more employees, and second was the complete failure of internal controls. Now, here I would like to tell you one interesting fact is that during the period 2011 to 2018, auditors' responsibility did not include review or evaluation of internal controls. RBI realized it after PNB frauds, and from 2022-23 onwards only, auditors are asked to review and submit their comment on evaluation of internal control. And if you see the latest audit report of PNB, auditors talks about IT controls. So that shows the importance of internal control which are employed within the IT systems of the company. Today the accounts are not maintained manually. I'll say most of the cases they are maintained in computer based systems which are in say Tally, SAP or other ERP systems. So IT based controls are more important than the traditional controls. Then the other case which I have covered in this in my earlier presentation, which was a lengthy presentation of more than 30 minutes, there I discussed two case studies. One was PNB, another is FTX. So briefly I will try to touch upon those points here only. See, FTX was third largest crypto exchange in the world, and it had, in January 2022, its valuation was made more than $32 billion. It received its C round of funding of $400 million. And by the end of 2022, it filed bankruptcy case. Why? Because there was a complete failure of internal control system. Now in a crypto exchange, all the activities are automated. So internal controls which are employed within IT system, they become very important. This is what I wanted to highlight. This is not an Indian case, it's an international case. Now in India, we have internal financial controls, and I'll not spend much time on it, and I think most of you understand. I'll briefly cover. It covers internal financial internal controls or financial reporting, then operational controls, fraud prevention. These all combined together is called internal financial control, which is defined in section 134 of the Companies Act. Now, if you look at the global scenario, which I have tried to compare between India, US and UK. UK has the most robust, I'll say, internal risk assessment system, which is COSO 2013 framework. So the robustness of internal control framework is highest in US. Second comes the UK. UK has got UK combined code, which is known as Turnbull, and this has got medium, but we are hearing for quite some time. I recently had a talk with FRC people also. One of their committee members, he was a co-speaker with me in Newark in a conference, and UK is expecting a similar COSO kind of framework in UK. So UK at the moment is a medium, I'll say risk, robustness is medium in case of UK, but if you look at India, the current auditing standard, IT risks are not adequately addressed. So in India, I'll say internal control framework is weak. Now going back to this PNB case, one of the things, auditor's responsibilities was not included in this evaluation of internal controls, or not included in the auditor's responsibility. And second is, what was included in the auditor's responsibility? Its responsibility included adhering to Indian auditing standards. So Indian auditing standards, so far as internal control is concerned, it is SA 315. So during 2011 to 2018, SA 315 did not address risk relating to information technology. So auditor's responsibility in those years was zero on internal controls. Now coming to, gone are the days when accounts were maintained in manual systems, manual books of accounts. So what was more important is, like, books are preserved safely, so keeping in the Almirah and ensuring what we call is, those bugs, they don't, spoil the books account, that was more important. But today, these accounts are kept in a digital format. So digital environment is basically characterized by a few features, which is like connectivity. See, internet has made connectivity possible globally. Today you can connect through internet anywhere in the world. Second is, see, today decisions are not based on personal judgment, they are data driven decisions. See, most of the companies are using data to find out which is the best option for them in a given case. Then automation is happening. See, automation is also not something new which is happening for last decade or more than that. Then access to information is not limited. See, with internet and all the social media and all, access to information is easily available to everybody. So these are all, impacting decision of a company. Then continuing with the digital age characteristics, disruption. See, we are in the fourth industrial revolution where emerging technologies are disrupting existing business practices. Not only in industries, they are also disrupting in accounting and auditing industry. So those emerging technologies are impacting. Then globalization. See, what has happened is, after the advent of internet, entire globe has become a market. See, today you can buy anything from anywhere. Most of these restrictions on import have gone away. Then customization of all the processes, things is happening very fast. So these are some of the characteristics which auditors need to keep in mind because they are auditing in digital age. Now the challenges which are coming up due to digital age include, one is data security. See, data is more in a digital form. So security aspects are different. The cyber security has become more important. Second is data integrity. Data integrity, completeness, accuracy and relevance of data, this has become very important. Now here I can say, see, data integrity, if you want to know more, see, this is a new professional opportunity also. Both AICPA US and CPA Canada, they have come out with a guidance on how to evaluate the criteria for data integrity. So, if anybody is interested, I can share that document. You can have a look at it and then think about data integrity in the companies where you are auditing. Then real-time reporting has become more important. See, what has happened is with the emerging technologies coming in and internet connectivity making everything possible, now real-time reporting has become more important. So controls need to be designed keeping this thing also in mind. Then adoption of technology has increased over, say, last 2 decades, I'll say. Emerging technologies such as artificial intelligence, machine learning, deep learning, RPA. Then more than RPA, intelligent process automation is also coming. Then blockchain and DLT system, they all have become important in today's digital area. Now continuing with the challenges in financial reporting, data analytics is very commonly used in accounting and auditing globally. If not in India, but I'll say in US and Europe, entire Europe, data analytics is very commonly used by auditors also. In India, yes, definitely top accounting firms are using it, but it is time for other auditors also, small chartered accounting firms also, to catch up with them, use data analytics software and make their audit reports more qualitative. Then standardization of processes is happening everywhere with the use of technologies. Transparency has increased in, say, last 2 decades in every aspect of life, including accounting and auditing profession. Then regulatory compliance has also become more important. I'll say in the decade of 2000, after Enron and all those internal controls, all those compliance requirements have increased. Similarly, we are also seeing in India this internal financial control. Now, if we talk about internal controls, there are 2 kinds of control. One is traditional control, which you all are familiar with, which you all have been testing and seeing in your client's place for decades. But in case of digital age, access controls, logical controls, data encryption, network monitoring, network related control, data backup, disaster recovery, DCP BRP, disaster recovery plan, business continuity plan, they have become more important, and internal controls needs to be designed keeping these things in mind. Now, internal controls, so far as information technology is concerned, they can be classified broadly into two aspects. One is general controls. General controls apply to all kind of IT infrastructure, and second is the application controls. Application control will apply to application specific. In the next slide, this is general IT control, which includes say applications, database, operating system, and network. See, I'll not go much in detail about it. See, the new now while I was discussing comparing the internal controls in US, UK, and India, where I mentioned about SA 315. See, after I completed this presentation, then this draft revised SA 315 has also been released. And although I have not gone through the entire draft, but I presume that all those IT controls are there and they will take care of it. So in case you are interested in learning more about it, you can read about revised SA 315, or you can refer to ESA 315, which was issued in 2019 and which is mandatory. Now, relationship between general controls and application controls, you can see in this slide. See, general controls will apply to risk of unauthorized change to application software, risk of system crash, risk of say unauthorized change in the master files, and risk of unauthorized processing. And application control will be specific to a particular application. For example, cash receipts application controls, payroll application controls, sales application controls, then other cyclical application controls. Now, to improve the effectiveness of these controls, what you can do is, one is companies can employ a robust cyber security system, which will include say implementing robust cyber security policy, cyber security mechanism, firewalls, then this antivirus softwares and all. Then risk assessment is very important. Risk assessment need not be made for the first time, and it needs to be made on a regular interval, and gaps and any vulnerabilities needs to be identified. Then monitoring should be made automated. It is more important in case of network because network is on 24 hours. So online, this automated monitoring tool for network become more important in this case. Then segregation of duty, which was there in traditional controls also, this is present in IT related controls, so that should be mentioned. Then emerging technology, they should be used like AI, ML, or deep learning. Now, in conclusion, I'll say digital age presents new kind of challenge which are related more to the environment, use of emerging technologies. So, auditors need to make a risk assessment which are related to IT environment, which are related to information technologies being used by the company or the entity. Then, internal controls needs to be designed to address those risks. And auditors see for control assessment, process mining, if you have not heard, there are some tools which are available, process mining tools like Saloni is the leader, then IBM processing tool is a UiPath is also there, Soroco is also there. One of these tools can be used in control testing. They do process mining, so you can identify the deviation from the process. Manually, it is not possible to test control in an IT system. Then other is review of internal control. It is not one-time job, and it needs to be made on a regular interval basis, and vulnerabilities and gaps needs to be identified, and internal controls needs to be designed, needs to be updated from time to time to address those risks. Thank you.
We have 2-3 minutes, so before I give my concluding comments, I'll first like if the audience has, if participants have any questions.
In the morning session, chief guest was also talking about then when we start asking lots of questions, then people start seeing us as a villain. And we have also ended this session based on the internal controls. We deeply appreciate that internal control should be there. We deeply appreciate that auditors are given responsibility to evaluate internal controls. But the problem is that when these reports are tabled, but actions are not taken or the findings are coming out, that somebody who has violated the processes is somebody maybe near and dear to the management. And then management itself tries to hide it. Then how does a professional go ahead? What is the solution to that?
See, professional responsibility is to review and evaluate internal controls and also ensure that internal controls are working. In case they are not working, they need to list down the cases where internal controls have not worked and then adequately report in their report. Their responsibility is over. Whether management responds or not, it is not their outlook.
But sir, in that case, how we stand to contribute? It is something like that something has been reported, but then nothing happens on this. So entire effort that goes into finding it out, that is also kind of wasted, isn't it?
No, see, auditors are reporting to whom? They are reporting to the shareholders. So shareholders need to take the management to the task. Why there is a deficiency in internal controls, why there, why the auditors are saying that, internal controls are not adequate, okay? It is not auditor's job to see that whether it has been followed up or not, no. Their responsibility is to report, that's all.
Let's say when it is reported, right? And then management at that point is resisting that report to reach to the stakeholders.
I think, I think that's a much wider thing.
Yeah, that is.
No. So let me try. I think I'm still on the lines that Mr. Vinod Kashyap said, and I'll maybe steal a bit from what even Lalit mentioned. It's all about integrity, right? Now, when you say management is trying to hide it, etc., these are very specific circumstances, and one needs to understand. If I am an auditor, I would like to see how, nothing, like he said, nothing stops me from bringing out in my report, right? There are legal requirements for these reports to be available, right? So the stakeholders will get these reports. You bring out the issue very clearly in your reporting format. And I'm talking about stakeholders larger than just shareholders. Anyone who is entitled to have access to these reports will kind of take cognizance of it. The market will, discount the pricing of such companies in an appropriate way. Now, if you're saying if your indirect maybe indication is to say, okay, they will not let you put it in the report itself, right? That goes to the basic issue of integrity. If whatever it talks to your strength as to how do you manage the company pressure. Now, just because a company is putting an X pressure, Y pressure, whatever, you can't say I will not report it. If you're talking about yourself as a professional, I think very clearly you are governed by reporting requirements, and forget reporting requirements, it's your basic ethics. Even if something didn't call it out very specifically, would you not? And if I may just take the opportunity to connect this with what Lalit said, I wanted to make that point. Some of these issues which have been coming up, and probably your issue is somewhere connected, and we really need to see what is the root cause, right? Now, is it lack of guidance, wherein, let's say now the NIFRA is also coming out with guidance. For example, they said they've come out with on revenue reporting and so on, and even for the fraud. Or is it something else? Because if it's something else, and if it is so widespread, then I'm not really sure whether SQC helps, because then is it that each firm is lacking in these processes, because these seem to be repetitive across. So I think a bit, I know it's a stretched answer, but the point I was trying to make is that it is all about choosing the right clients, asking for the right, actually if you have the right fee, you will choose the right clients, you will make sure you have the right resources, and that will help you execute an audit with proper quality. I don't think, I'll let the other panelists also add. I don't think there can be any other answer to say management is putting pressure. You still have to bring it out the way I see.
I think basically, it's that auditor job is basically you have to find out the facts and keep the facts before the, that management. Your job is not whether they are implementing or not, that's a separate thing. But keeping in mind that facts should be, that should not be hidden. So that is the things, and we believe in karma basically. So we always believe we should go do always, that keep working, keep working, keep working. Someday, I mean, will definitely somewhere it will start.
I'll just supplement this. What we have learned as part of our trainings is a report is mine, right? What is written on that piece of paper under my signatures is what I decide to write. The only thing that I need to make sure is I'm factually correct, right? There could be an opinion also which has to be justified, and it has to be well thought out. Once you have done that and you have given your report, and if you believe that management does not take corrective actions, appropriate corrective actions. I mean, I'm sorry, your question sounded as if person is not held accountable. I'm not on that, right? If management is not sensitive to your findings, is not taking corrective actions, to me, that company, that entity does not deserve to be my client. So I'll show them the door, right? That's what Archana says. Choose your clients very carefully.
So maybe that year you're not able to resign or whatever. I mean, those are very facts and circumstances driven. But then that's something. Choose your clients appropriately, and yeah. And don't think. I really do not know what's in your mind when you say action not taken, etc. Like I said, the stakeholders will make sure that there is appropriate discount when it comes to investing in that entity in whichever form. Anyways, I think in the interest of time, any other question? Yep. So brief. Yeah.
Well, it is a problem for a small and mediocre firms to implement all the regulations. Like the ma'am is talking, the majority of the problems comes in mediocre firms where they are only private limited companies as a client, and they do put a lot of pressure on the auditors, because a listed company can have a more freedom in terms of disclosures. But a private limited company, the management has more say. How should we deal with that?
It's a myth. It's a myth. Listed companies have their ways and means to put pressures on auditors, right? So just don't go by private and listed companies. Somewhere, the corporate world has got an impression about the profession. If this CA will not do, someone else will do. And it is because of that the profession is suffering. Thanks to SEBI's initiative, Institute's initiative, there was a technical guide on resignation and what resignations were asked to be, including reasons, MCA looking at those reasons. I think these questions warrant a self-introspection. Were we, when we resigned from a client, when there was a limitation on scope imposed, right? Did your resignation say? We simply write a letter to a fellow chartered accountant. Do you have any objection? No, we don't have any objection. Yes, that's the benefit that the companies have taken off the profession. Start writing, use your pen. I would want to see a situation in this country when a company does wrong, it is not able to find an auditor. Nobody should be willing to touch that company. That is what the profession has to do. And yes, this will occur. There will be firms who will pick up, there will be chartered accountants who will pick up when you leave a job. But at least do what is right and what you can do. Of course, do take care of your physical safety is one thing. Yeah, that's also, I mean, I talked about psychological safety, but do take care of your physical safety as well, right?
So I agree with Lalit. I think the pressure at times can be more in listed entities. But the point I want to make is slightly different. It's all about, it's repetitive. Choose your clients. I mean, if you feel, do you have the right resources? If you feel this client is too complex for you, right? I mean, just see whether you have the right talent, right knowledge to execute. If you have, then you shouldn't be. Then it all boils down to fee dependency. Then you're saying I'm dependent on a client for revenue, and that actually can be for any firm. Small, medium, large, any firm can have, and that is why if you look at the Code of Ethics, there are very specific provisions in terms of dependency of fee. And again, I will say it goes back to your ethics. I'm going to repeat something I was told in the initial years of my career, and I feel if you stick to it, it just takes you through difficult times. No client is bigger than the firm, and one client can bring the firm down. So you choose, do you want, tomorrow that client may even go away, but do you want to put your signature on something wherein the firm is at risk? So I think it's something to introspect and then just choose the clients. Let me, I mean, I'm sure everyone has their own challenges, but I think there's enough work. You can choose the work that you can do with the right resources or the talent that you have. And then I think this will automatically fall in place. So I think we don't have time for more.
And at least there has been one example in my career where a company knocked the door of firms and did not get an auditor because somebody decided to leave that client. So it happens, and it will happen.
Yeah, sorry, we're 10 minutes behind time, so I'm just going to close. And I just wanted to say, the challenges we're discussing, I think they become much, much more when I think about the impact of technology. And I was just talking to Mr. Kashyap during the break. I said, when I look at AI, etc., data governance, all these issues, they're just going to make audit much, much more. We'll actually have to see how to adapt, how do you trust AI and so on. And the last message I just wanted to leave everyone with is that we also spoke about management commentary. So globally, there is a management project which is going on. I think right now, if you see, you've got integrated reporting, you've got management reporting, now you've got your sustainability, and there quite a bit of overlap. So there is initiative going on to see how can you bridge these so that it's much, much easier rather than duplicating efforts. And because the topic is about financial and non-financial, there is quite a bit of interaction. These are not really isolated, like we saw even through management discussion. We also realized through technology. And even at the regulator level, if you see IASB and IASB is working together. They're not working in silos. They are interacting with each other. So there is a lot of interaction between these two considerations. So just wanted to make that comment. Yeah. Thank you so much. So okay. Do we hand over to anyone? Okay.
Thank you very much, all of the dais, for this very engaging and discussion at length. And I'm sure that there are many more questions going forward connected to this program as well. And I appreciate your this openness to say that, Lalit sir, that you mentioned, okay, use your pen. And that's where we all, in whatever profession we are, at least what we contribute, that is somebody somewhere is being, we are watched over. And if that replicates in somebody else's actions, that will definitely make change in some ways. So thank you very much, all of you, Madam Archana ji, Binod Kashyap sir, Lalit ji, and sir. May I request Haldia sir, if you may like to add on to the concluding remarks. Thank you very much, ladies and gentlemen, for your being patient, listener, and your contribution to the engaging discussion through the day. And we look forward to your continued participation in our further activities coming up. If you have any suggestions, any more questions, you may please write back to ASSOCHAM, and we will take to the speakers if they may answer your questions. We will come back to you. So look forward to your continued support and participation and endeavor. Finally, I would extend a vote of thanks to all the partners of this conference, speakers, the organizing team. I would extend thanks to BDO being the knowledge partner, True and Fair Professionals Network being the event partner, technical partner was Majars in India, and Bombay Stock Exchange Investor Protection Fund for supporting this initiative of third International Conference of Financial Reporting. And I am grateful to entire NAFRA team and Bhanod sir, ED NAFRA, he is also here. I acknowledge his presence, and he has been through the day with his team here. CGM sir, and thank you Dr. Ashok Allia sir for guiding this ASSOCHAM's task force that you are leading, and scheduling this entire under your mentorship this we could deliver the third international conference on financial reporting. I hope that participants would have found this program very useful, insightful. So far the number of sessions and the topics have been included in the conference, and would seek your further contribution or seek your further inputs in case if you have any to include in our future activities. Thank you very much once again. Thank you so much.